Boom. Yo, what is up for y'all watching this on the YouTube replay? I hope you're having a great day. Let me give you a quick portfolio update. The market is not open today, but I want to go over some stocks to potentially look at to buy the dip on next week. Oh yeah, like Wingstop. That's the first stock we're going to go over. Surprise, but they're actually a royalty play. Pretty interesting stock right there. But yeah, here's how we did on Friday. We were up like 1%, or again, on the week, we were still down 0.32%. Year to date, we're still doing pretty decent. We're up 11.8% year to date. Let's actually compare that to the S&P real quick. The S&P is up 12%. So actually, we have just barely underperformed the S&P 500 year to date. And this is known as my dividend-only portfolio because every stock in here pays a dividend. Most of these, as you can tell, are like dividend growth stocks, though, like Meta, Google, CEG. But yeah, you're really buying them for the stock price appreciation. But the future dividend growth is going to be huge on a lot of these names. We also have a Roth IRA. It's done not great. We started it exactly a year ago, pretty much. We're down 1% all time in here. Here are all the stocks that I own in here as well. I really am bullish on HCA Healthcare. I really like this name. I'm like a little biased on this one, but this is some of the most impressive financials I've ever seen for a company. Also, Iron Mountain had a little rebound on Friday, which is great. So yeah, then we also finally have our Moomoo portfolio, and then I'll go over Wingstop. The forward PE is still expensive at 55 PE, but let me tell you why I actually think Wingstop is worth looking into. So this right here is our Moomoo portfolio, which is known as our buy and never sell account, where once we buy a stock in here, I try not to ever sell it. I'll never trim a position. If I trim it, then I fully sell out of it. So also, I just made a new watch list. Wait, it removed some of them, or did it just like not load them in? Well, that sucks. I made a new watch list called Safe Never Sells. Yeah, it removed the other names in here. That's so weird. I know I had like waste management in there. Okay, oh well, that's weird. Anyway, we'll build up that watch list a little later. But anyway, let me show you Wingstop real quick. This is a restaurant stock, but they're really a royalty play, just like McDonald's. Hey, what up, Looney? Good to see you, homie. Yeah, we can look at Microsoft too. So yeah, if we go down here, check this out. Actually, 46% of all of Wingstop's revenue comes from their royalty revenue, basically their franchise fees. Whenever you go spend like $100 at any Wingstop, they keep like 4 to 5% of it. So they collect $4 to $5 in royalties for every $100 spend, and then they have the advertising fees. It looks a little. It like has these. Don't worry about that. It's not actually negative. This thing is just glitched right here. But yeah, their company-owned restaurants are only 20% of the sales. That's what I like. It's just like McDonald's, where the company-owned, corporate-owned stores are very low, and most of them are franchised. And then they collect the royalty revenue. And I don't know about them, but they might own the land under the stores. I don't know. So if you go to the revenue right here, the revenue is up 8.15. But the operating profit is up to 48 million, up 22%, which was great. That annualized is basically 200 million, and they could probably, this growth rate, they're probably going to be hitting that. So they're making basically 200 million a year. Still an expensive company, but they also pay a dividend now. They also sometimes do special dividends. But check this out. They made, it says they made 30 million net income. It was actually slightly higher than that, but let's just say they made 30 million net income. They pay a 0.5% dividend yield, and the dividend only cost $8.3 million. So yeah, they're also doing some share buybacks as well. Yeah, check this out. If you go to the net income is up by 10%, but the net income per share is up by 16. Pretty crazy. They spent like a couple hundred million on buybacks a few quarters ago. So yeah, let's check out Microsoft right here. This is one of my favorite Mag 7 stocks, a great never sell stock. If you had the intention to never sell Microsoft, like it's worth buying right now. The PE ratios are 33, like 33 PE for Microsoft, like the second world's third biggest company. I'll happily pay that. So, and I might actually look to buy them in my Roth IRA. But check this out. They have their huge productivity and business solutions. Like think of like PowerPoint, OneDrive, Word, all that stuff. So they've really converted from a hardware business selling like computers to a software business, a way higher margin industry. So yeah, that's over 120 billion of annual revenue for them. They also have this intelligent cloud business, basically their Azure cloud. Is literally at a record 30 billion this quarter. That annualized is crazy. And if we just go to their net income down here, after tax net income, after they paid 7 billion of taxes, they kept 27 billion in net income. They're literally making over 100 billion of after tax net income every single year. Wow. Wow. Cash from operations is 45 billion. Like this is no wonder they're like $4 trillion company. So they're spending a couple like 4 to 5 billion on buybacks a quarter. They return you money in dividends as well. So yeah, I really like them. How can I invest without documents? Um, oh, you can't do that. No, hey, you can't invest in stocks without documents. That's just not possible. Because you got to pay taxes and stuff. Okay, or if you want to no, there's no brokerage exists that won't ask you for your information and send you a tax form. So if you by the way, I have all three of these brokerages. If you're interested in the stocks, want to buy stocks, this one, all these brokerages are on the link tree in my bio. The very first link there is this brokerage I'm on right now called Moomoo. It's my favorite one. Costs nothing, no fees. Most useful analysis tools. Like it does all the breakdown. Like let's check out SoFi Tech. Yeah, hey, what up, Linus? I actually do own some SoFi. Here's what I love about SoFi. Yeah, there's a bunch of other tools as well. Like you get the Morningstar research, which says like what do the bulls say and what do the bears say about SoFi. But here's my own little analysis. First off, SoFi is expensive even after this dip, and it's not worth buying meaningfully yet. In full disclosure, I am a shareholder of SoFi. I regret every share I've ever sold in them. But this is what justifies SoFi high multiple, though. They definitely deserve a high multiple. But if we go to their financial services right here, this is what's unbelievable. The growth of this. It's up 76%, after grew 101%, after grew 140, after grew 280. Like, this is insane. And this beats all analyst expectations. And we can see the analyst expectations down here. That's the orange line. Every quarter, they beat on revenue, they beat on EPS, and they beat on EBITDA every quarter. So no wonder on earnings day, they're gapping up. That's why I think people are just starting to really take SoFi serious now. They're making real after-tax net income, over 100 mil a quarter now. Sales are really growthy. Like their main lending business is also at a record, up 25% year over year to basically 500 mil for the first time ever. Really impressive numbers on SoFi. Great growth stock. You think Mara is good here? I actually don't think so. Or it depends on obviously what you think of Bitcoin, but I've looked at every single like Bitcoin mining company out there, and I'm not just picking on Marathon, but I've looked at HUD 8, Core Z, Hive Digital, all of them that exist. CleanSpark. There's not a single Bitcoin mining company that has actually ever outperformed Bitcoin. So there's just not a realistic world where I'd ever recommend a Bitcoin mining company over actual Bitcoin in the long run. So that's hopefully that was helpful. Like again, we can pull up any Bitcoin mining companies, not just Marathon. Like look, like Bitcoin has done awful compared to this one as well. So yeah, like here's CleanSpark. All this company does is just mine Bitcoin. Yeah, 100% of the revenue. Okay, let's see here. Google and Microsoft, Meta, Cash Fortress. Oh yeah, Ryan. Yes, sir. Yeah, dude. Actually, should we look at Meta stock? Yeah, here, let's do Meta right here. I saw what up? I don't know what that is, but what's up, dude? He said Meta in the chat. What's your opinion on Pulse? Yeah, hey, we don't really look at cryptos on here. SoundHound, hey, what's the ticker symbol for them? We'll check them out too. Yeah, if you got a stock you want me to look at, let me know with the ticker symbol. But here's Meta right here. Legit 20 forward PE on this company. So they're trading at 20 times next year's net income. You know, what I find fascinating is a lot of companies like OpenAI, for example, and ChatGPT. ChatGPT used to never spend anything on ads, but now ChatGPT is now putting ads on Facebook and Instagram to try and get more users when they need to get that growth back. They need to spend on growth now. And this is the best advertising play. I mean, if we go to their active users, legit 3.54 billion daily active users. That's nuts. But one reason the stock did fall on earnings is because they had a one-time tax charge of 16 billion. We can tell it was a one-time adjustment because you go to the operating profit. It actually was a record Q3 revenue as well, over 50 billion in revenue for the first time, and they kept 20 billion of that. Their margins are at 82% gross margins and 40% net margins. Again, one-time adjustment here on that one-time tax charge. That'll never happen again, but here's one thing investors are questioning: how much you're spending on CapEx. You know, if we go to their cash from investing activities, again, you want a company to spend money on new assets, but 20 to 25 billion a quarter is a lot, and that is being questioned right now if they can get real returns on this. Because they were even complaining about when they were spending a bunch on the metaverse back here. But honestly, Meta can afford to spend on AI. It's actually they have now a net debt. They now have a net debt position for the first time ever. They've always been net cash positive. Now with these bonds and stuff they issued, I think for the first time ever, have a net debt position. So they're literally taking out debt and issuing bonds to be able to invest in so much in AI. So I really like what they're doing though. Like the Meta Ray-Ban glasses are awesome. We can like scroll through Instagram and Reels on the glasses. You know, those are cool. They even took a big stake into that stock. What app do you use for analyzing? Yeah, hey, Line, is this? I use this app right here. This is actually a brokerage right here where you buy stocks. And if you want to get this app I'm on right here, it's in the link tree in my bio, very first link there. Full disclosure, it is an affiliate link. So if you go and like deposit $100, we'll both get like some free stocks. By the way, all these brokerages are all in the link tree in my bio as well. Someone said, do you like Webull? I do like Webull. I also have a Webull brokerage, and I also have a Robinhood brokerage. You know, I got all the brokerages. But out of all three of these, though, if you're new, I would get this one right here. Literally costs nothing, no fees at all, no commissions, most useful analysis tools, in my opinion. So yeah, link tree in my bio, very first link there if you want to check it out. Or you can just type it into Google, just a broker called Moomoo. Okay, so let's see here. Oh yeah, SoundHound. Let's check out this one. Got assigned to a SoFi. Hey, nice, Ryan. Oh, we can look at Amazon too, Terawolf, Walmart. Yo, Walmart had some great earnings. So here's SoundHound AI. This one is an AI audio software subscription company where like you feed it a bunch of data of your own voice, and then it can like talk. You can give it a script and it'll talk and sound like it was not AI. But anyway, look at this is what you focus on for the whole company, their subscription revenue. In 2023, you know, it was a nothing burger, 400K of revenue a quarter. Well, now these growth rates in the middle are pretty impressive. You know, it's 33 million of revenue this quarter, up 78 after it grew 3,000. So, and they've been beating on expectations. It looks like last quarter was a big beat. You know, 32 mil. They did 42. Looks like they beat by 2 million this quarter. Big miss on EBITDA. They expected them to lose 39 mil. Well, they actually lost 115 mil. So that certainly is being questioned. But it's not the end of the world because they have the top line growth, but not one I'd trust a lot of money in. Just I'd be careful. I don't know if there's a moat there really. Let's see. What do you use on Webull? Yeah, hey, these are all the stocks I got on. Hey, I love being fully transparent. Check this out. Like, we've done terrible. Look at this. Our open profit and loss, we're only up 8% all time in here. Someone was saying Sprouts. Hey, should we look at, you mean Sprouts Farmers Market? Someone said. Let me know if you're talking about that one. We can check Sprouts out. We're down 39% on them. We're only up 8% all time. Definitely underperformed. Don't listen to me. I'm not an expert. By the way, I sell nothing. I have no course, book, WhatsApp, Telegram. Please watch out for people impersonating me. I'll never follow you, DM you, nothing like that. Hey, what up, Duck? See you, man. So let's pull up, actually, Terawolf right here. Google, I believe, wait, what's their, Terawolf. So I think Google sold their stake in this company. Yeah, Google used to be the largest shareholder. But Google fully sold out of their position. Looks like the growth is back from basically a loan, but the revenue is up 86% year over year. But here's the bad part. Even when you exclude this one quarter, the market has gone up a bunch. What's the market cap? So, wow, $4.7 billion company that was like losing. I mean, I just don't love. Honestly, it's not the end of the world. The growth is really good. 86% after 42. That's great top line growth. These are bad losses. You know, 500 mil this quarter. I suspect it was from this issuance of some sort of bond or debt, but I don't know. Digital. Is this a Bitcoin mining company? Digital asset mining. I didn't know that. So 85% of the revenue comes from that. And then high performance computing leasing. So they're basically leasing out their excess capacity, I guess, to maybe servers. Interesting. I don't know. It's kind of like a Coreweave or really small Coreweave. Okay. Let me get to Sprouts Farmers Market right here. Then we'll get to Amazon, because Amazon is kind of Sprouts Farmers Market and Walmart too, like their biggest competition. Sprouts Farmers Market isn't the same though. Like they're a more healthy grocery store oriented kind of store. And that's why they have abnormally high margins. They have way higher margins than Kroger, Costco, Walmart, all of them. They have a 5 to 8% net margin, and that's why I still love Sprouts Farmers Market. This is the reason I'm buying them. The PE ratio, I can't believe this. It's a 15, and that's not on some like one-time adjustment. Like they really trade at 15 times PE. They're easily now making well over 100 million of after-tax net income a quarter. So, and they're spending most of that. What are they doing with the 100 mil of plus a net income a quarter? Well, since they don't pay a dividend, they're spending 50 to 100 million dollars a quarter buying back their own shares. And when they're buying back their own shares at a 15 PE at this price, like that's great news. So yeah, the net income is up by 31, but the net income per share is up by 34 because they bought back 3% of all the shares, which is basically the same as a 3% dividend, but just a non-cash dividend. Arguably better because you don't pay the tax till you sell. Okay, well, let's see. Sprouts Farmers Market, I'm a fan of them. I do own them. And let me show you this. We're down bad on them. We are down 38% on them. But I think the risk reward looks great here, and I'll actually be looking to buy more. Yeah, really a 15 forward PE as well. So the growth is going to basically be flat for a year, but The Actually, I'm gonna re-put them to the top of my watch list just so I can rewatch them more because the more I look at their numbers, the more they really are impressive. Okay, let's see here. Okay, actually, let's get to Walmart first because we just looked at Sprouts Farmers Market. Now let's look at Walmart right here and let's see what they reported versus what the analysts expected. So they beat on revenue. A huge beat on net income. They expected 59. They did 77. So let's see here. So easily, Walmart prints money, and actually, Walmart has the most valuable like real estate portfolio in the whole United States, more valuable than McDonald's. Like they have like in terms of these warehouse logistics hubs in like the 5 mile triangle of every city. Walmart legit has top five most valuable real estate portfolios in the entire U.S. and they make heckin' net money, easily 5 billion plus of net income a quarter, and you get a nice yield, almost 1% dividend yield. They raise their dividend every year to beat inflation. Sam's Club is doing good. I love that business model. It's like a Costco type business model, Sam's Club. So yeah, just a great defense name. Even when the market's going down, usually like if Nvidia sells off, like Walmart's known as recession resistant, recession resilient. So that's what I love about Walmart. Hey, Stocks and Sports Guy, what up, dude? He said, I bought NVIDIA and APH on Friday. Hey, nice, dude. I am so bullish. I'm mega bullish on Amphenol stock right here. Forward PE of a 33. Even after they've appreciated so much in stock price, the forward PE is very fair. And I'm even more bullish than the analyst expectations are. I'm more bullish than them on their EPS and EBITDA numbers they're all going to report. Like this is the in companies one part of their business supplying NVIDIA. They're the main supplier of NVIDIA for their copper cables. Like the NVLink spine uses 2 miles of copper cables supplied mostly by Amphenol Group, and they print net income. They're known as like the nervous system of AI. Hey, watch out for that guy in chat. I'll permanently get him off TikTok because I have a guy now. If you ever see someone in the chat say, the first 5 people to message me will get $7,500. Hey, actually, I'm copying his name right now. All right. So yeah, if you ever say, by the way, I saw nothing. I have no course book, WhatsApp, Telegram, nothing like that. Please watch out for people impersonating me. I'll never follow you, DM you, literally nothing like that. Okay. Let's see here. Apple, yeah, let's do Apple right here. Apple has been so rewarded. They were green on Friday. They were up 2% on Friday. Apple's being rewarded for not spending on the AI craze. Like Google, Meta, Amazon. They're spending like 20 to 30 billion dollars a quarter on on their cash from investing activities, but not Apple. They're spending nothing because they don't need to. They're actually using Google's Gemini now. Apple is paying. Did you know this? Apple now pays Google over $1 billion a year to use Gemini integrated with Siri or whatever. But that's what Apple does. Like they're smart for not spending on everyone's going to spend so much. LLMs will get significantly cheaper, and then Apple can just choose the best one. So anyway, Apple, if we just go to their net income right here, prints easily 25 to 30 billion of after-tax net income a quarter. And what is Apple doing with 25, 30 billion net income a quarter since they're not spending on AI and stuff? Check out the buybacks. This is insane. If you look at the top here, they're spending 20 to 25 billion dollars every quarter solely buying back their own stock. And the dividend only cost $4 billion. So, all right. Let's see. And they have a nice dividend. Yeah, 0.4% dividend yield. And they're really, iPhones, that's their hardware business. The iPhone sales have been flat. Like for the past 4 years, the iPhone sales have been flat every year. But the most valuable part of Apple is actually their services business. This is now over $100 billion of annual revenue for them. So whenever you go spend $100 in the App Store, Apple takes $30 of that as a legit royalty, as a developer fee. Developer platform fee, they call it. Same with Google Play Store. If you go spend like $100 on Clash of Clans gems, the Google Play Store and Apple keeps $30 of that. And that's where that's all super high margin. It actually breaks it down. Let's see. You can see the difference of the margins between the software or the gross margins of the services versus products. Because they sell Macs, iPads, the wearables, but here's also why Apple was so affected by tariffs back here. Because did you know only 36% of Apple's revenue comes from the U.S.? They're actually more revenue comes internationally than from the U.S. EU is 26%, China's 15%, Japan 7%. So I like how diversified they are internationally, and they just have great numbers. A perfect, in my opinion, buy and never sell stock. Now it is expensive right here, but I think other Mag 7s are potentially more attractive at their current price. I think Amazon, Meta are two good ones. Meta's dog cheap, 20 forward PE on them. So, let's see here. Someone said, "Hey, what up? Running," said Pinterest. Let's do this one. Pinterest right here. This is like a cash player. Check this out right here. The whole company is worth $16 billion. Remember that. The whole company is worth $16 billion. And they have, let's see, no debt at all and 2.7 billion in cash. So $2.7 billion of cash. And that cash isn't just sitting there doing nothing. Since they have no debt, they're not paying any interest. They're actually keeping their cash pile into these 1 to 3 week treasury bills. And it literally made them they're making that every quarter, 28 million of positive interest on their cash. So their cash is earning them more cash. They did have, if we go to their net income right here, it says they made 1.85 billion this quarter. They didn't actually, they only made 260 million. So that artificially inflated their EPS, which artificially makes their PE ratio look lower than it actually is. But check this out. Here's their active users. This is kind of good too. Their monthly active users are 600 million. When this exact same time last year, it was 537 million. So that grew. Looks like they met on expectations. I don't know what their mode is. Saudi completely exits Pinterest stake. Okay, whatever. Interesting. Hey, what up? Celerate said GRRR. Let's check this one out. So he said, everything, would you appreciate your opinion, especially with their future contracts and 7 billion pipeline, 100 mil cash? So let's check this one out. So yeah, very low market cap. This is why you probably don't want to trust a lot of money in this one, but let's see, a $300 million market cap. So the whole company's worth 300 million. They have this security convergence revenue. It's over 100 million in revenue, or a yearly revenue for them now. Let's see. So they did 26 million in revenue this quarter. They missed, very slight miss on revenue, a miss on EPS, but a beat on EBITDA. I suspect the EPS miss was because of the dilution. If we go to the cash and financing activities, they diluted you by 100 million. Again, that's 1/3 of the entire market cap of the entire company. So that permanently makes their EPS go down by 1/3 for the rest of the time, which is unfortunate. But it might have just saved them though. Like they fortified their balance sheet right here. The sales are up 32. I don't know if investors expected them to dilute you by 1/3. But let's see right here. I think they have like 110 million of cash on hand, and I think no debt. Basically no debt, 4 or 5 mil of debt. So let's see. Actually, look, this is what's super interesting. Actually, this is fascinating. Well, the operating profit fell 40%, so something's happening to their margins. Yeah, look at their gross margins. Gross margin fell 22. Trying to really investigate why this one is trying to look at every aspect here. So yeah, revenue's up 32, but they made 3.5 mil of profit. Only lost 28K of net income. Interesting. It might be a decent risk to reward there. I don't know. Hopefully that was helpful. How come Webull doesn't show daily active users on Pinterest? Well, hey, exactly. Webull isn't as useful as I do have Webull, but they're just not as useful. I also have Robinhood as well. So is that what happens? Yeah, I have all these brokerages right here. If you want to get any of these apps, they're all in the link tree in my bio. But this is my favorite one. This is why we're on this one. Very first link in the link tree in my bio. My favorite brokerage to buy stocks on. It's completely free. It's an affiliate link too. So if you're going to deposit $100, we'll both get like some free stocks and stuff. So let's see. Rick said Coreweave. Oh yeah, here's another cool feature about this brokerage. You can see like the, hey, what up, Papa Dan? Good to see you, man. But you can see like the super investors portfolio, like the Nancy Pelosi portfolio. You can see their exact holdings and weightings. Like Warren Buffett, you can see his holdings, exact weightings, and his most recent changes. Like he for the first time ever, just bought Google. And when the day he bought Google a few days ago when it was announced, stock went up like 4 or 5%. But we want to go over to NVIDIA's portfolio right here. NVIDIA is so big that they literally own some individual companies, stakes in them. And one of their main holding is Coreweave. So they actually lowered their guidance a little bit on earnings. So let's see here. Hey, thanks, movies. I appreciate that. So yeah, Coreweave right here. Let's go to the earnings hub. Here's another kind of cool thing. You can see the AI like earnings hub. So this is what's really fascinating. If you look at the number 2 line here, their contracted backlog nearly doubled quarter over quarter to $55 billion. They have literally in contracted backlog of $55 billion of revenue they haven't gotten yet. But here's the bad news. That backlog isn't going to get fulfilled as fast as they thought because their third-party delays in data center deployments and increasing scaling costs. So their operating margins was below expectations at just a 4%. But they had crazy new contracts, a $14 billion new deal with Meta and a $6.5 billion expansion to the previous OpenAI deal, which is fascinating. Coreweave, Nebius, APLD, they're all like the same thing. They just own a bunch of data centers and cloud hosting networks. But check this out. The growth is insane on Coreweave. Revenue went from 590 to 1.3 billion, triple digit growth for 4 quarters in a row. And if we go to the analyst expectations, they're expecting 2.3 billion in 2 quarters from now. Again, they're still losing 100 to 300 mil in net income a quarter, and analysts are expecting them to keep on losing like 250 mil a quarter. But the growth is nuts on there, and that's really what people are probably going to watch, the top line growth there. I wouldn't have it as a major size position yet. Hey, Nebius too. Yeah, hey, Nebius, this is another one, actually another one owned by NVIDIA as well. If you go to the NVIDIA portfolio, they own Coreweave, APLD, and Nebius. They're all basically the same company to an extent. But, wait, what is this? CNBC's Jim Cramer warns of capital concerns, spotlights Nebius. Really? Okay, well, let's get Nebius. Actually, what's crazy about Nebius, they got a $16 billion cloud deal with Microsoft. So Microsoft's part of their Azure cloud is going to Nebius's servers, and that's led to crazy growth expectations. Their revenue is already a record this quarter, 146. It's going to be 469 in 2 quarters. The growth is expected to like triple, even like after already being insane. Like it's up for, it was 32 million the same time last year. Now it's 150, and then just in 2 quarters it's going to be 500 mil. And if we go to the EBITDA they're still expected to lose a bit of money. But interesting on Nebius there. Let's see here. What's this one here? Taiwan Semi here. Yeah, sorry I didn't get to that one a bit ago. Let's do Taiwan Semi right here. So Taiwan Semi, if you didn't know, NVIDIA just designs the chips. Taiwan Semiconductor actually manufactures them for NVIDIA in Taiwan, but they also have this Phoenix fab, and they actually just completed their first ever Blackwell chip ever about a month ago in Phoenix, which is pretty interesting. Because one big concern is one of the main reasons the U.S. took a government in Intel is because Taiwan Semiconductor, our main manufacturer for our main chips, is 6 feet away from China. And we need to honestly be more manufacturing independent, so that's why we're stimulating Intel. But check out Taiwan Semi. This is insane. Their market shares is 71%. They make these 5 nanometer wafer chips that they just keep raising prices on. If we go to the revenue, hold on. First off, this is, again, a Taiwanese company, so we'll convert the currency to USD just to better understand it. But this is nuts. Revenue of 32 billion, up 35%. So the revenue is 32 billion. Out of that 32 billion of total revenue, 14.8 billion of that was net income. After paying 2 billion plus a tax, that's insane. They're doing 10 to 15 billion of after-tax net income a quarter. What's the forward multiple? A 23. A 23 forward PE, which is about 10 to 15% growth. They're totally going to achieve that. Plus, you get a 1% plus dividend yield here. Taiwan Semi is one of my favorite stocks in the market. So if we go to their net margin, back to what I was saying, out of their total revenue, 32 billion revenue, 14 billion of that was net income. They legit have 50% net margins. Basically the same as NVIDIA. It's crazy. Okay, so let's get to the next one here. CrowdStrike, the people bought a 5% stake in Mercedes F1 team. Wait, really? Wait. Oh, the CEO, CrowdStrike CEO. Hey, wait, do you want me to look at CrowdStrike? I think CrowdStrike reports earnings not this Monday, but the next Monday. Hey, what up? Good time. Good to see you, homie. Let's see here. UNH stock, UNH is slowly kind of bleeding out, unfortunately. So basically, the stock has been propped up in the past on overbilling the federal government and unethical kind of practices of selling people that back brace they didn't need. And it's kind of now fully recognized they can no longer do that to the government. And so basically, here's the bad news. If we go to the revenue growth was great, 113 billion of revenue. But if we go to up 12%, so the sales are up by 12%. But the net income is down by 60. And not some one-time adjustment either. The real operating profit, the core business, fell by 50% year over year. It's rough. Now their net margins was 2.2. So Let's see what the EPS projections are. So, it looks like there is supposed to be a rebound in net income to 618. But what's the cost of the dividend? So, or actually, let's go look at it specifically. So, this quarter in net income, they made 2.54 billion. Remember that number? They made 2.54 billion this quarter. And the dividend costs $2 billion, so they can still afford the dividend. Dividend's not at risk, but that's a little unfortunate because that eats up a lot of their profit that they need to kind of retain right now. UNH, they're still interesting though. Buffett actually bought the dip on them. Buffett, the day it was disclosed he bought it, the stock, gapped up. So basically, there's a lot of future uncertainty that we just don't know. And that's, we're a customer. We use OptumRx. That business is booming. The top line is booming. Over 133 billion of revenue there. UNH does over 300 billion a year. So interesting name, but I wouldn't have it as a major size position. Hey, shout out to Dr. Onefly. Dude with like the 20 roses. No way. If you got his stock, give me a look at, let me know. Hope you're having a great day. Let's see. Let's do Kroger here. We'll do Kroger here. Then we can get to Eli Lilly. So right here is if I were to get a stock, what would you recommend right now? Hey, what up, Clint? It's a lot of stuff is bad to buy right now, but for the backbone of your portfolio, just buy the S&P 500. Most retail investors and hedge funds cannot outperform the S&P 500. So you literally need to have this as the backbone of your portfolio. And if you don't have it as a small position. And if you don't have it as that, you need to own the major components of the S&P 500 or you will underperform. These hedge funds are now going more into the Mag 7 stocks to keep up with the S&P 500's performance because they can't. Because it's like the nifty 50 of the market is really what's dragging up the stocks. But anyway, I would buy some individual S&P 500 companies that love and use. Meta, McDonald's, Google, Constellation Energy, United Rentals, Amazon, Coca-Cola, Kroger, decent too, Walmart, Oracle, don't buy some junk, small caps. Okay, so here's Kroger right here. This is a grocery store, very low margin industry. If we go to their net margins, they're lucky to have a 2% net margin. That's actually why what's the PE on this company? A 16? Sprouts Farmers Market trades at a lower valuation and has 2 to 3x the net margin and does more buybacks. But actually, you want to see something crazy. They weren't able to and they weren't allowed to acquire Albertsons, the grocery store chain, because of regulations. So what did they do with their excess money? They spent $5 billion on share buybacks. Here's that in the whole that one quarter, the whole company is worth $43 billion. Well, at the time it was like way back there, but here's what that does to the net income and the EPS. So if we go to the net income is up by 31%. So net income's up 31, but the net income per share is up by 42. They bought back 11% of the entire company just in the past year. So those buybacks are insane. Again, it was because they couldn't acquire Albertsons, but they make easily 600 to 800 million net income a quarter. The PE is a 16. It's like a boring grocery store that'll probably won't outperform the tech-heavy S&P 500. You get a 2% dividend yield, but I think it's a nice staple to own. Kroger's recession resilient. So Kroger's a good never sell. So let's pull up Eli Lilly right here. This is that prescription company. They own so many different prescriptions. And one of the reasons Eli Lilly is booming to an all-time high is because of their Zepbound, their weight loss prescription. And their weight loss prescription Zepbound actually got added into Medicare Medicaid for $140. Is being offered to Medicare Medicaid customers for $149 a month. But look at Zepbound specifically. Here's this business. They created this in 2023. The growth has been immense. It's, at a record, it just hits a new record every year, every quarter. On top of all their other prescriptions as well are all booming as well, like Mounjaro. The triple digit growth rates in the middle are just nuts. And we can also just see they're beating on expectations every quarter. Big beat on revenue, beat on EPS, big beat on EBITDA. $5 billion plus in net income a quarter is just insane. Plus a 0.5% yield, not too shabby. What app are you using? Hey, what up, Truth? Yeah, by the way, if you want to get this app I'm on, it's actually a brokerage, software you buy stocks on. It's in the link tree in my bio, very first link there. Full disclosure, it's an affiliate link, so if you go and deposit $100, we'll both get some free stocks. But yeah, my favorite brokerage, free, cost nothing. So let's see. Hey, shout out Isaiah. What up, dude? He said thoughts on Dell. Ooh, someone said Home Depot. Hey, remind me to look at HD Home Depot, because I really love that company. Hey, yo, shout out to the member Jeff Mack and Looney on the YouTube stream. We'll check out NOK after this. Okay, so here's Dell Technologies. They're a cheap company, a 17 PE, $83 billion market cap. They're really competing with Supermicro eating Supermicro's lunch right now. But yeah, PE of 17 is pretty fair for Dell, and you get a 1.5% dividend yield, and the payout ratio really is like a 28% safe payout ratio. But it's a low margin, like yeah, low single digit margins, kind of like Supermicro. But check this out. If you go to their infrastructure solutions group, which is like installing servers and stuff for uh, companies, that business boomed. It's 16 billion this quarter. That's a really big increase. What about their other business? Client solutions. Looks like this is a bit of a slower grower. This might explain why the multiple is so low, low. So it was negative for a long time. Um, so let's go to their net income. But this is the thing, if we go to their net income right down here, they're easily making well over $1 billion of net income a quarter if we average it out there. Yeah, that's after they paid, 500 mil of taxes every quarter. So they're making easily $1 billion in net income a quarter, and the dividend cost every quarter, 366 million. If you're wondering why did the cost of the dividend go down, how did it go from 396 to 366? That's because of the buybacks. Again, whenever a company buys back their own shares, they don't pay dividends to those shares anymore. And they spent $2.3 billion last quarter solely on share buybacks. They're spending heck of money on buybacks right now. It's actually very interesting. So net income's up by 32, but net income per share is up by 38. Wow, so they bought back 6% of all the shares that existed on top of paying a 1.5% dividend. That's actually, I might sell Supermicro to buy Dell. Interesting. Let's see. Wait, what's the cash? Did they buy a company? No, not really. No. Okay. Sound like, why does he sound like Charlie from Smiling Friends? Oh, I've never seen that. I'm curious to hear what he sounds like now. But here's Home Depot right here, and then we'll get to NOK. I think that's or we'll check them out. So here's Home Depot right here. Interest rate sensitive play. The Home Depot CFO said there were a lack of storms, and that's why the earnings missed. I guess it kind of made sense because the same time last year there was massive storms in Florida, North Carolina. But anyway, if we go to their net income down here, this is still great. Easily 3 to 4 billion in net income a quarter, but the margins did fall a little bit. Their net margin fell 4%, but still great net income, 3 to 4 bill a quarter. Actually, they just bought a company for $6 billion. Actually, I wonder if let's see, is there AI earnings up for this? Revenue growth was supported by a $900 million contribution from the GMS acquisition. So I'm not sure what GMS is, but it looks like they acquired some GMS. Weaker profitability was pressured by weaker margins. Management highlighted challenges from reduced. Oh, yeah. Hey, it's here too. Management highlighted challenges from reduced storm demand and slower housing turnover, while acquisitions like GMS and SRS are expected to strengthen customer. Okay. Well, anyway, I think the risk reward is pretty good on Home Depot. 23 PE. That 23 PE is probably fair for a company that's not growing their net income and sales. But as rates get lower, maybe they'll benefit. What's this app? Yeah, hey, again, if you want to get this app I'm on, it's in the link tree in my bio, the very first link there. Actually, Isaiah, I actually do like Dell. Isaiah, actually, I think it's worth going and scrolling back on my stream and watching my segment on Dell. By the way, I'm streaming on YouTube as well. My YouTube channel is called Nathan Roberts, also in the link tree in my bio. But Dell is actually fascinating. The buybacks and the dividend, like, it's crazy. They've bought back 6% of their shares and paid a 1.5% dividend. Actually, Dell's interesting. I can see why the stock is like at that multiple though, but let's pull up NOK right here. So this is, Nokia. I believe NVIDIA took a $1 billion stake into Nokia. So Nokia plans a $4 billion US investment in AI network connectivity. Hey, that's pretty interesting. So, because I know a lot of the revenue doesn't come from the US, let's just check that out. Actually, this is a European company. So first off, we'll convert the currency from euros to USD just to better understand it. So yeah, look at this. The United States is only 26% of the revenue. Other is 42%, Finland, India. So interesting. Let me actually see what were the results, or what does AI have to say about the results? Network infrastructure revenue grew 11% year on year, benefiting from increased demand in cloud and AI. Optical networks achieved 19% revenue growth. AI cloud infrastructure supported by new semiconductor facility expansion. I didn't know they were getting into semiconductor facilities or that. So if we go to their operating profit, yeah, that did fall 10% year over year. But they still made net income. So they beat on revenue, they missed on net income, but they beat on EBITDA. There was some good news from that $1 billion NVIDIA stake. So, I don't know. It says the forward PE is a 15. The right now PE is a 30. Because they're investing a lot right now. These investments should pay off. But yeah, their net income is like artificially lower right now. Or, I don't know. Anyway, interesting name. Hopefully that was helpful. Hey, yeah, no problem, Isaiah. If you got another stock you want me to look at, let me know. I got you. Yeah, hey, no problem, Pericles. Yeah, if you guys wanted to follow button, we stream every day. Sell nothing, no course book, nothing like that. So here's Fastenal. This is a $45 billion company. I think they make like fastening systems, and actually the stock on a monthly has done very well. But they reported earnings on this day right here. That's why they gapped down on earnings day. Let's go see what the results were, because I don't remember looking at this company. Let's see what caused that big decline. Or wait, do they have an AI overview? No, they don't. But let's go down here. So revenue met expectations, EPS or net income missed, and EBITDA missed. So yeah, they make fasteners, safety supplies, janitorial supplies. Hey, that's actually pretty growthy. Look at that. That's up double digits to a record, actually. Their janitorial supplies business. Tools, hey, it's up 9% year over year. Hydraulics and pneumatics up 13. I like how diversified that they are. Materials handling, and they're all really growthy, it looks like. Maybe there was something investors didn't like there. Like, what about their main business? Fasteners up 14%. Let's see here. So sales are up 11. Net income is up by 12. Yeah, they're making $300 million plus in net income a quarter. A 2.13% dividend. That payout ratio looked high. Let's see if that's real. So they're making 300. We'll call it 300 million of net income a quarter. And the dividend cost 250. That is a bit of a high dividend payout ratio. 250 mil. They make 320 mil. A bit of a high payout ratio, but a phenomenal balance sheet. Look at that. Like no debt at all to pay. So it's like a mixed bag there. Actually, the risk to reward might be decent on there. Forward, or the PE is at 37. They're saying the forward PE is at 35, or what was it? 33, near 34. So, interesting name there. All right. Thoughts on yeah, hey, no problem, Jeff Mack. You got another one. Let me know there. Celery said GTEC. So this is Greenland Tech, and then Coreweave. Thoughts on Coreweave? Do you see a double? We'll check them out. IVP, Hood, Coca-Cola. Hey, we'll check. Hey, what up, Caden? Thanks for that rose earlier. Yeah, we'll check out Coca-Cola after this. So in Hood, and so here's Greenland Technologies, a really small company. If you look at the top right, this whole company is only worth $18 million. So very, very small company. I normally don't cover these, but we'll give them a chance if they're making net income. So that's actually the pretty interesting part. I don't normally like to touch these, $18 million companies, but if I was going to buy a company worth $18 million, I would at least want to buy the one that, if you average it out there, it actually looks like they're making consistent net income. Revenue it's up 25% after it fell 14, but it looks like the growth came back now. Okay, balance sheet. It did deleverage actually. Cash from operations was 8 mil. It's actually not too shabby of a company. It looks like, okay, so here's the one thing notice. They're making 3 to 4 mil of like net income, or like 2-3 mil net income. I think the net income, the EPS too. Analysts are expecting the net income to basically go negative again and they lose 2 million. But even if you average it out, there's probably be like just one of those one quarters. I don't know. Again, would not have anything meaningful in there, not a lot of money, but maybe put, $10 in there. I don't know. Let's see what their website is. But yeah, leading developer, manufacturer of electrical, vehicle, and power systems. So that's their whole website. Okay. Oh, that's the IV. Okay, let's go here. Okay, Coreweave, this one's another big one owned by NVIDIA. If we go to the NVIDIA portfolio right here, their largest holding is in Coreweave. Now, they have major deals happening right now, but they have this crazy backlog right now. They literally have a $55 billion backlog of orders they need to fulfill, like contracted backlog. But they said that there were delays in third-party data center deployments and increasing scaling costs. They weren't able to basically fulfill the backlog as fast as they want to, and there's going to be delays. So they lowered their guidance on that. But check this out. Their growth was still crazy. The revenue growth was fueled by large contracts, including a $14 billion deal with Meta and a $6.5 billion deal expansion with OpenAI, world's biggest AI company. Check out the revenue went from 580 to 1.36 billion. But the bad news is they're still losing 100 to 300 million net income a quarter. And analysts are still expecting to lose, 2 to 300 million a quarter, 300 million net income a quarter. So they're basically expected to lose a billion in net income a year. But they need to keep with this top line growth, and I totally expect them to, especially with the contracted backlog. The revenue is going to be 2.32 billion in 2 quarters from analyst expectations. So that's actually really interesting. But yeah, I don't know. They don't have too much of a moat, just besides their good customers contracts. But it's just a company that owns a bunch of data centers with NVIDIA chips in them, doing cloud server hosting. I wouldn't put a crazy amount of money in there, but it certainly might be worth looking into. The valuation is so expensive on there because, again, they're losing so much net income. I don't usually like to buy companies that lose that much net income, or especially not with a meaningful amount of money. So let's see. Hey, let's see. Undeniable. What up, dude? You said, can we look at Bros? Yeah, this is Dutch Bros. I think this is one of the better restaurant stocks to buy the dip on. Hey, what up, Pudgy? Yeah, remind me to look at SPMO. Yeah, there's some stocks I'm missing here. I'm so sorry. I wanted to look at like Coca-Cola. We'll look at Coca-Cola after this, Caden. So here's Dutch Bros right here. Let's see what the results were. So this is like a Starbucks competitor. They own, those Dutch Bros like coffee shops. I got like a milkshake there. It's great a long time ago. But if we go to their company operated shops, the revenue is really growthy. Revenue's up 27, after grew 30, after grew 37. In this environment right now, in this super tough environment, so many restaurants are getting wrecked right now. If we go to their franchising and basically their franchise royalty fees, it's also, I like this part of their business. It's basically royalty revenues. Like if you go spend $100 at any Dutch Bros, they keep like $4 of it. But that's the McDonald's model. I'm sure they probably have something similar. But yeah, they're making good net income, 27 million net income. After they actually shouldn't be a little higher than that. It says they paid like 15 mil of taxes, or they went to something else. But yeah, sales are up 25, net income's up too. And I would rather buy them than some of these other restaurants on a dip. Like look at Wendy's right now. A lot of these restaurants are struggling. Wendy's is at an all-time low. Like Jack in the Box, RIP this company. They're at like an all-time low. I mean, when was the last time you've been to one of those? Krispy Kreme, Krispy Kreme's at an all-time low. The whole company, Krispy Kreme's only worth 600 mil. McDonald's is worth 220 bill. What's this app called? Hey, what up, Palm? Yeah, by the way, this is actually a brokerage where you buy stocks on. If you want to get this app I'm on, it's in the link tree in my bio, that very first link there. It's an affiliate link too, full disclosure. So if you go and like deposit $100, we'll both get like some free stocks. Broker called Moomoo. But someone said Coca-Cola, or Caden did. That's actually a stock in the Buffett portfolio. If we go to Warren Buffett's portfolio right here, we can see his exact holdings and changes. Actually, Warren Buffett, for the first time ever, a new position. He just bought Google as a new position. But his third largest holding is Coca-Cola, a great dividend growth kind of recession resilient company. Here's what this brokerage is telling me. What is this right here? A bullish continuation triangle, and the rise probability is an 88%. So here's what's cool about Coca-Cola. If we go to the dividend right here, you get basically a 3% dividend, and they raise their dividend every year to keep up with inflation. But you get a basically 2.8, 3% dividend. You get 3% of your money back in dividends every year. Then you usually get 3 to 4% in stock price appreciation every year for a total return of 7%. So I don't expect Coca-Cola to outperform, the tech-heavy S&P at maybe an 8 to 10% CAGR, but I still probably expect this one to return 7% money a year. It's a good staple, recession resilient. I really like them. Like same with McDonald's. I actually own the Coca-Cola bottling company, which is also like an all-time high. So yeah, they've all done great. Hood stock. Let's do Hood. And then SPMO. SPMO. Is that the Comcast. Hey, I want to look at Comcast too. Remember to get to that one in a bit. This is the Invesco S&P 500 Momentum ETF. So this has really outperformed the actual S&P 500 because it's a bit more tech heavy. Look at the difference of their top holdings. Their number one largest holding is actually Broadcom, and then Nvidia, and then Meta. Notice there's no Apple or Microsoft on here. Then it's JP Morgan, Netflix, Palantir, Walmart. So, which are all great stocks. It's actually an interesting, very interesting ETF right there. Let's pull it right here. And hey, I didn't even see that. Yo, Isaiah, dude, thanks for the Meerkat gift there. I appreciate that. Yeah, we'll look at Comcast after this too. And then, hey, what up, JVM? Spotify's looking nice after a job. Hey, we'll pull up Spotify too. And hey, let me get to IVP. I'm missing so many stocks here. I'm so sorry. Okay, so here's Robinhood right here. I have I have a Robinhood account. I've been using their account for many, many years. I've probably given them a lot of transaction fees and monthly subscription costs. But here's Robinhood, their app right here. Phenomenal numbers. Their net cumulative funded accounts, which is the metric you actually want to look at, is 26.8 million versus 24.3 million the same time last year. So it's really growing organically. And if we go to the revenue, this is nuts. The revenue's up 100%. After grew 36. After grew 30. And then look at this revenue. The sales were 1.27 billion. Out of this 1.27 billion of revenue, they netted 556 million. This is the net income, 556 mil. That's after they paid, 100 mil of taxes or 89 mil of taxes. Like that. So they literally have a 44% net margin. These brokerages print money. If you're wondering why is Robinhood doing so good, it's because this brokerage actually just recently introduced this prediction market stuff. And they introduced, well, this is old, but crypto transactions. They make a lot on crypto transaction fees and that prediction market stuff. So, because whenever you buy and sell a stock on a brokerage, they don't make too much money, which is also why I'm also now buying Webull stock, which is this brokerage right here. I'm going all over the place. We own Webull in our Robinhood portfolio right here. We actually now own 50 shares of Webull, but Webull, this brokerage right here, also just introduced the prediction market stuff to their app and crypto back to the app. So, kind of like a smaller Robinhood. Another great one that's honestly the best brokerage if you were to buy brokerage stock is FUTU. This is my favorite one. And that's this brokerage right here, publicly traded. All right, let's get to Comcast right here, CMCSE. By the way, if you want to get any of these apps or these brokerages I'm on, they're all in the link tree in my bio. The one I'm on right now is the first link there. It's just called Moomoo. You can just type it into Google, broker called Moomoo. So here's Comcast right here. This one is a slow grower, and that's why this one's kind of being punished right now. They're the same prices they were back in 2014, but they have a super safe dividend. They're doing insane share buybacks. But if you go to their main source of revenue, which is over half of the business, this residential connectivity cable business, it's going to continue to decline single digits for the rest of the time. So this is kind of like slowly going to zero as Netflix streaming platforms really take them over. So they're really needing to invest a lot more in their other business, like their media business. If you didn't know, they own like Despicable Me and that whole franchise and a bunch of other, I think that's all DreamWorks and all that. They have the studios, theme parks. So yeah, Universal Studios and all that, like Legoland's under them. And if we go to their net income right here, if we go to the sales right here, this is the thing, the revenue, the lifeblood of the company, the sales are down 2.7% year over year. So the growth is negative, sales are negative, and the net income is also slight bit negative. Yet net margin fell 6% year over year. But this is the good news. They had a one-time adjustment last quarter. They didn't actually make 11 billion. They made 5.99 billion, a 9% decrease, but they're easily making 3 to 4 billion in net income a quarter. Well, actually more close to 4 billion. So they're making 4 billion in net income a quarter. And here's the crazy part. The dividend only, where is this? The dividend only cost 1.22 billion. So they actually have still some room to raise the dividend, but yeah, they don't need to raise the dividend because you already get a super safe 5% dividend yield. We want to see them invest a lot more in their other businesses. Let's see cash from investing activities, and they are. Looks like they're spending 4 or 5 bill a quarter, which is good, but it hasn't really paid off yet. Growth is still negative. So okay, let's pull up this one. IVP, someone said. Oh yeah, then we go Spotify and SMR with the new drop. I'd rather get CEG. We'll check out their numbers. Oh, actually, we're not going to cover this company. Yeah, dude, what the heck? If you look at the top, this can't be the stock you're talking about. If you look in the top right, the whole company, this whole entire company, the whole business is worth $450,000, $450K. I'm sure someone in here could buy this whole company. So yeah, we're not going to cover that stock. Sorry. That's not even a, okay. Spotify, let's get to this one right here. This one's really expensive, but it's starting to get less expensive, which is good. Let's actually see what the forward PE is. The forward PE is a 44. That's actually not too terrible. That's probably reasonable. 44, actually still a little expensive, but Spotify always trades expensive. It's reasonable for them to trade a 44 forward PE. So their monthly active users grew 11% year over year to wow, that's a lot. 713 million. Wait, that's 10% of the world, right? If population is 7, or I don't know what the exact, but fueled by emerging market expansion and upcoming Netflix video podcast partnership, their premium subscribers, the people that are actually paying for their stuff, increased 12% to 281 million, supported by localized pricing and new features like lossless audio. Well, let's see. Yeah, here's their total premium subscribers, 281 mil. That's most of their revenue. How's the ad-supported revenue doing? That is down 5% year over year. So the ad-supported revenue isn't doing good, but their main premium business is up 8% year over year. A bit of a, actually, well, if we combine the two revenues, the sales are only up 7% year over year. That's not great. But if we go to the net income, they really do print net income. They had a one-time adjustment this quarter and last quarter. It says they made 900 mil this quarter. It says they lost 90 mil last quarter. They didn't actually. They're making 400 to 500 million of net income a quarter every quarter. And these are still good growth rates. They are expanding their margins and stuff, which is good. But yeah, they're going to be making like 2.3 billion in net income a year. So just do 120 divided by 2.3. Well, let's see. That's our own forward P. 120 divided by 2.3. So in my eyes, and this is a little slight generous, 52 forward PE. Moomoo's saying 44. All right. Thoughts on QQQ this coming week? Hey, quick advice. If you like the QQQ ETF, never just buy and hodl the QQQ. Always buy the QQQM. It's the exact same ETF run by the exact same people with the same NASDAQ 100 strategy that is performed identical. This one I'd buy over instead QQM. It's because it has a 0.15% lower expense ratio fee. So for every $1,000 you put in, you're saving $15 a year in expense ratio fees. Of course, Invesco doesn't market QQQM because then they make less fees. All right. Let's see. So favorite turnaround play. Someone said SMR. Over SMR, I'd much rather get a CEG, Constellation Energy, 27 forward PE. That's probably because of the Calpine acquisition. If you guys don't know, this company is acquiring Calpine, and it closes in Q4 this year. So any day now, whenever they acquire Calpine, it's instantly accretive $2 of yearly EPS. So that's 50 cents of net income a quarter that's just going to be added to their EPS for the rest of history, which is just nuts. Well, that news has been priced in now for a while. That's why they gapped up way back when. But CG is the number one nuclear plant in the world. In the US and in the world, they literally own 30% plus of all the US's nuclear reactors. There is no close second. Second place would be Vistra Energy, but far second, compared to their 32. They own 32 reactors. Vistra Energy owns 4. But this is the largest pure play for nuclear energy. And with the natural gas, or they're the number one geothermal play. They literally own this one. It's called the Geysers. It's a geothermal plant that literally takes the steam coming out of the ground and converts it into electricity. There's just one plant supplies 20% of all of California's clean energy. Okay, let's keep going here. Target stock. Target's a bit boring. Oh wait, was there another stock I wanted to look at? I don't think so. Okay. Coinbase. Hey, Coinbase just added, or no, that was PayPal. PayPal just added I don't know. We'll look at Coinbase. Coinbase just did something. Or no, Coinbase added the prediction market stuff, dude. Oh my goodness. Everyone's getting to this prediction market stuff because they realize Robinhood is printing money on it. We'll get into Coinbase after this. But here's Target right here. If we look at the price of Walmart, Costco, they have massively underperformed all those names. And why has Target done so bad? It's because they're less of a grocery store. They sell more discretionary items out of Target. Food and beverage is only 22% of their revenue. Then they're in apparel, household essentials, home furnishing and decorations is 15% of their entire business. How's that doing? Look at these just declines in the middle here. For the past years, it's just been on declining trends, hard lines, beauty products. How's that, discretionary item. But let's see here. Here's the thing. If we go to the revenue, the lifeblood of the company, the sales are now negative, negative, single digits. So revenue's negative. Actually, whoa. That's terrible. So the revenue's down 1.5, but the net income is down by 19. And that's not some one-time adjustment either. The net margins really did fall 18% year over year. But that's so bad. Did analysts expect that? Yeah, big miss on EPS. And sad part was that the operating profit really did fall with it. So they made $690 million in net income. Here's how I used to look at their dividend. I used to say, hey, this dividend's really safe. If we average it out, they're doing $1 billion in net income a quarter. But now with the $680 million quarter, it makes me question that. So I used to say they make $1 billion a quarter, and the dividend cost $500 million. So that's a roughly 50% payout ratio. But $518 million in net income, or $518 million how much the dividend cost, and they only made $690. That's a bit of a higher payout ratio. So I can totally see why Target stock is struggling way harder than like Walmart, like basically at an all-time high, I would call it. So I'd be careful with them. Probably wouldn't have it as a major size position. Hey, what up, funny? Is there any stock you'd recommend now? I really like Sprouts Farmers Market stock. Ticker symbol SFM. I'm down bad on that one. Again, I can't recommend anything. None of this is financial advice. I'm not an expert. I don't sell anything or nothing like that. But yeah, Sprouts Farmers Market, I think, is at a pretty fair price right now. Um, Meta too. If you like Instagram, Facebook, Threads, WhatsApp, Meta owns all that. The Meta Ray-Bans glasses. So I think Meta's a good deal here. 20 forward PE on them. Microsoft, surprisingly too. Microsoft, I think, is a great deal here. What site or app is this? Oh, hey, yeah, what up, movies again? If you want to get to, or actually, I'm not sure what app you were talking about there. I got all these apps here. I got somebody. These are all actually brokerages. Again, brokerages are where you buy stocks on. They ask you for a bunch of information. They all send you a tax form at the end of the year. That's normal. So if you want to get any of these brokerages, they're all in the link tree in my bio. They're all affiliate links. This one I'm on right now is my favorite one. Low. It literally costs nothing, no fees at all, no commissions. Very first link in the link tree in my bio, and the most useful one. So yeah. Okay, it's called Moomoo. Yeah, I love this one. So let's see. Ooh, PANW. Crap. This one is owned by Nancy Pelosi. If we go to the Nancy Pelosi portfolio, she owns a lot of stocks, but one of the stocks she owns is Palo Alto Networks. This is a cybersecurity company, and I love the cybersecurity industry. And they're finally starting to get to a normal multiple. They're trading at 86 times. They're trading at 86 times next year's net income. So still expensive even after the dip. But cybersecurity always trades expensive, always, like way more than like a Salesforce, Adobe, because cybersecurity is not impacted by AI. Like the AI thesis is straining on Salesforce and Adobe, but not so much cybersecurity, because cybersecurity is like hackers will utilize AI and get better at it. But I love Palo Alto Networks, their subscription model play. 55% of all the revenue is their subscription business. And check out, I wanted to get to Coinbase. That's what it was. I'm going to get to Coinbase. But their subscription revenue, literally, this is what you want to see for a stock. Like this is what justifies that crazy multiple. Literally just hits a new record every year, every quarter, just grows double digits. They're making a couple $100 million net income a quarter. The free cash flow is even better, $1 to $2 billion free cash flow. Actually, I think they just acquired CyberArk, or they're planning on that. Let me go down here. AI weekly thing right here. Where is it? It's not. Oh, yeah, right here. It's Palo Alto Network. Oh, this is a different acquisition. So Palo Alto Network to acquire Chronosphere for $3.35 billion. Chronosphere reports $160 million in annual recurring revenue. So they're spending $3 billion. The whole company's worth $130 billion. So that's not. I like that they're doing acquisitions. I do. They can afford it. I think they're also acquiring CyberArk. Let's see here. Coinbase. Let's get to Coinbase right here, because I wanted to get them one a minute ago. So yeah, if we go, actually, that's a Kathy Wood play. If we go to the Kathy Wood portfolio right here, 4% of her portfolio is in Coinbase, and Coinbase has been struggling, obviously, because it kind of rhymes with whatever Bitcoin does, kind of rhymes with the price of Bitcoin. They're trading at 35 times next year's net income. So that's an all rightly fair multiple. You can see down here, this is actually a very important metric. This is their monthly transacting users. So not just monthly active users, but monthly transacting users are 9.3 million. And I wanted to pull up this weekly news. Coinbase acquires Solana trading platform Vector. Okay, I wanted to see the, acquires Echo platform for 375 mil. Cloudflare outage disrupts thing. Coinbase confirms White House ballroom project donation. Company also donated 68 million of crypto focus. Okay, whatever. Let's get to Coinbase right here and their actual numbers. So this is good growth. Revenue's up 55%. Yeah, last quarter was only up 3, but they brought the growth back. So revenue's up 55. Looks like they're making, if you kind of average it out here, actually that looks really weird. The operating profit versus net income. Probably making like 500 million net income a quarter, we'll say. They're spending a lot buying new companies. It's actually pretty interesting. So, I don't know. I couldn't find the news because it probably happened happened a while ago, but I'm pretty sure Coinbase is bringing the prediction market stuff to Coinbase after the successful results of Robinhood doing that. So, how do you see the Pelosi portfolio memo? Yeah, hey, to see the the Super Investor Tracker, you just go to the Discover tab at the bottom, and then you go to Insights, and then yeah, you can see all the Super Investors portfolios. Yeah, if you want to get this, actually a brokerage. If you want to get this app I'm on, it's in the link tree in my bio. That first link there. Hey, what up, Chris? Said CrowdStrike. Execs have been selling left and right. Yeah, CrowdStrike. I that's my second favorite cybersecurity stock behind Palo Alto Networks. Hey, what up, MCO? Can you review RMBS? Here, RMBS. Yeah, let's do it. Hey, we'll look at WDC. What's your favorite NVIDIA play? Probably Amphenol right now, but Comfort Systems, a big one. So here's Rambus right here. They're a $9.5 billion company. The stock has done phenomenal. So let's go check out, or is there an earnings thing here? No. But let's go look at the results down here. So the orange line is what the analysts expected. They beat on revenue. They missed on EPS, which is net income, but they met on EBITDA. So looks like the revenue says they're in the semiconductor space, and looks like the revenue grew 22% year over year. US is only 36% of the revenue. South Korea is 35%. But yeah, if we go to the net income down here, and it looks like this was a one-time adjustment as well. It says the net income was flat, but the operating profit grew 26. So the core business actually grew 26, or the profits grew 26. But they're easily making 50 to 60 million in net income a quarter. So they're definitely making good profits and a really good balance sheet. Check that out. Literally no debt on this company. And the cash pile is growing like a monster. So same with the free cash flow. That's insane. So yeah, from a fundamental point of view in the financials, I can totally see why this stock has done insanely well for the past couple of years. It's probably just struggling right now with the whole NVIDIA shenanigans, but interesting. Yeah, semiconductor space there. Do you use Moomoo? Yeah, hey, I do use Moomoo. Yeah, that's my, yep. Let's see here. Let's look at WDC right here. You got Western Digital. Let's see here. With all this insight, wondering why you don't trade options. Yeah, I'm just not good at options. I've tried options before. I feel like I can get similar returns to option traders just by, buying and holding great high quality stocks that should return 10% plus a year. Where that's the hope. Doesn't always happen. I definitely have some major losers. But here's Western Digital right here. They have been benefiting like crazy from all the AI demand. The forward PE is an 18, or what's the right now PE? The PE ratio right now, it's a 20. So they're trading at 20 times net income after all this crazy stock price appreciation. The net income is supposed to grow even more. But let's see. Revenue's up 27%. So the revenue's up 27, but the net income is up 140. Was that real? Okay, so that was a slight bit not real. But the core business, the operating profit, this is what you want to look at. That doesn't include the slight one-time adjustment. They're making 700 mil in net income a quarter. I mean, that's insane. The year-over-year comps, I mean, triple digit every quarter here. The revenue's up triple digits from the previous year. That's why, and the same with the free cash flow. Whoa. Like they used to be like, if you zoom out just 2 years ago, free cash flow negative. Now they're super free cash flow positive. Like, no wonder this stock is doing so well recently. Yeah, they're really benefiting from the AI demand. Roland said Okta, please. Yeah, my software at college, whenever I log into my software, it says in the bottom right, Okta in big letters. Wonder if they're like a cloud play. I don't know exactly what they do. We look at STX or try and get to all these right here. CATL. Okay, so thoughts on the price of N by next week on NVIDIA? Yeah, I don't know. So I think next week is Thanksgiving week. There's only 2 full trading days next week, I believe. And whenever there's the Santa Claus rally stuff, the reason there's always a Santa Claus rally is because there's no one trading. There's no sellers. Anyway, here's Okta right here. This is a software company. Yeah. So they traded 81 times forward net income, which might be reasonable, which might mean $78 is a fair stock price. Well, let's see what the growth rate is. So the revenue's up 12% after grew 16. So nice double-digit growth rate. And okay, so they're just now getting net income positive, basically. So that's good news. So they are making net income every single quarter. Nice triple-digit growth rates, but they're still trading at 88 times next year's net income. That might still be a bit expensive. But these year-over-year growth rates are what you want to see. Like everything here is headed in the right direction. Like they're not doing anything wrong. These numbers are great. They're deleveraging their balance sheet. That's a fortress balance sheet. Yeah, they have 900 mil of cash right now. Free cash flow looks amazing. Yeah, let's look at that. That's what FCF stands for, free cash flow. It's insane. Yeah, beating on expectations too, beat on revenue, beat on EPS, beat on EBITDA, but it might just be reasonably valued here. I don't know. Let me know what you think about that. So, STX, is that C? Oh yeah, Seagate Technologies. Yeah, look at the hype this one has experienced. Just like tripled in just a year or less than that. So yeah, let's check out their numbers right here. Or well, tell me the AI kind of thing. So check this out. Their data center revenue accounted for 80% of total sales, fueled by AI inferencing and cloud storage needs, with HDD shipments up 32% year over year. Non-GAAP gross margins reached a record 40%, so record margins, I guess. Seagate qualified Mosaic 3 plus terabyte HAMR drives with major cloud providers and returned $182 million to shareholders, including a 3% dividend raise. So interesting. So yeah, 30 PE. Let's see how they're growing. So the revenue is up 21%. So the sales are up 21, and the net income is up by 80. Wow. That's after they paid 120 mil of taxes, or 130 mil. So that's really good. They made 550 mil in net income this quarter. That's over 2 billion annualized. They could that 2 billion annualized could easily pay off this debt. They're deleveraging. Look at that. They used to have more liabilities than assets. Now they're the same. Dude, the free cash flow growth is nuts. So it's always financials and numbers that explain why a stock always goes through a crazy bump up. Like that last stock we looked at. What was it? STX, or the other one. Oh yeah, Western Digital. I mean, WDC also had a crazy growth in their stock price just because they're amazing numbers, and it makes sense. I think they pay a dividend too. What's the yield? Oh, a 1% plus dividend. Wow, nice. So let's see here. CATL. Payday soon. I'm thinking of investing into either more AMD or Rambus. Hey, nice. They're probably AMD is a little expensive here. Wait, someone said look at CATL. Yo, Al, I couldn't find that one. I typed in CATL, or unless you're talking about like this Hong Kong or this company. Which isn't the Hong Kong company, or maybe this one right here. Actually, this is a pretty interesting company. I put it on my watch list. I think they're like a patent play. It's again Chinese company, ticker symbol 300750. Oh yeah, check this out right here. This is kind of interesting. I guess I wonder if they're like registered in the U.S. too. But oopsie. If we go to their patents down here, I don't know what they are, but apparently they have 12.8 thousand patents for power battery systems. And anyway. MCO3, even with the current valuations, opinion on Microsoft would really, dude, Microsoft is a steal of a deal, I think. Hey, you too, Roland, have a great weekend. Appreciate y'all being here. Yo, by the way, if anyone wants to hit the follow button, we stream every single day, sometimes twice a day. I might do another stream later tonight. And by the way, I literally sell nothing. I have no course, book, Discord. I'll never follow you, DM you, nothing like that. Pudgy, we literally looked at C just like 1 minute ago. You got another stock you can look at, let me know there. So here's Microsoft right here. The valuation's pretty fair. The PE is a 33. So that's not like, for a Mag 7, that's very fair. If we go to their, premium subscribers right here, this is for their Microsoft 365 subscribers. So think Word, OneDrive, PowerPoint, all that kind of stuff. That's their main business. It's 42% of all their revenue. They've really transitioned from a hardware to a software company. If we go to their annual revenue, this is nuts. $120 billion of annual revenue on their productivity business. And then they also have their intelligent cloud business, which is, Azure cloud, so much cloud demand right now. They actually took 1% market share away from AWS this quarter, 30 billion of revenue that annualized too. So anyway, they just print net income. If we go to their net income, they made 27 billion of net income this quarter. So 27 billion net income last quarter, that's 27 billion net income after they paid 9 billion of taxes, and it went to something else as well. So this is like real 27 billion net income, and they're doing that every quarter, which is over 100 billion of net income a year. And the free cash is even better. Yo, hold up real quick. Shout out to Looney on the YouTube stream. Dude, no way. He just gave a $20 super chat. Yo, shout out to Looney. He says, keep up the great streams. Dude, thank you so much, man. No way. Looney, if you got another stock you want me to look at, let me know there. That's thank you so much. You just made my day. But yeah, here's Microsoft. I mean, again, they print net income over 100 billion in net income a year. What are they doing with the 100 billion in net income a year? 25 billion net income a quarter. Well, first off, they spend 5 billion on buybacks, 6 billion on dividends, which is so shareholder friendly. That's what I love about Microsoft, and they can easily afford to do that. Better credit rating than the S&P 500. So, or no, better credit rating than the U.S. government. I mean, just insane. So. My man, yo, Looney, you should see the TikTok stream, Looney. People are going Looney in the TikTok stream too. Yo, I appreciate that, Looney. Thanks so much. So CATL is a giant Chinese battery producer. Yeah, those patents were crazy. I think you were the one that first told me about that company. Like I never would have added this company on the watch list myself. Yeah, I think you told me about this stock, and the patents. That's a really interesting thing there. And if we go to their net income, it looks like they're well, this is in Chinese yuan. Again, wow, dude, this is in USD. They made 2.8 billion net income, up 41% after grew 30%. Oh, wow. They print net income. What's the PE? 26, forward PEs of 22. Actually, hey, check out that one right there. Ticker symbol 300270. What was it? But yeah, that's kind of cool. Oh yeah, I made this new watch list right here, and for some reason, it removed some of them. There's only two. I made the safest never sell names. So I have McDonald's, Waste Management, HCA should be in there, and some other names. But I think what was that ticker symbol? Yeah, 300750. All right, let's go here to this next stock. Hey, what up, Ishwar? What up, dude? Hey, remind me to get to Dell. We actually just looked at Dell just a minute ago, but give me a couple minutes and we'll look at them. I got you. Here's Waste Management, a phenomenal never sell company. I mean, if you have the intention to just like never selling, like Waste Management, like this should just keep up with the S&P 500. You can sleep very safe at night knowing this is going nowhere. People always got to throw away trash. AI can't. It's like AI proof. AI can't really hurt Waste Management's business model. Probably only make it better. They're printing net. Actually, they had a one-time adjustment to their net income this quarter. They really made like 800 mil. But they had this adjustment from this acquisition, like this healthcare disposal acquisition business. Anyway, Waste Management, one of the safest names out there. Just buy and never sell them. Bill Gates likes it. Bill Melinda Gates Foundation owns 7.2% of all the shares. Duolingo is one I want to look at as well. Hey, what up? Isaac said UAMY. Waste Management's going to be a beast. I believe in trash. Yo, me too. I mean, Americans are so wasteful, and 96% of the revenue comes from America. And hey, BLK in Magic too. Dude, thanks so much for that. I didn't even see that. Thanks for that gift back there. Did he say a stock? Yo, if you got a stock, you can look at BLK. Let me know in the chat again. I'll check it out. But here's UAMY, United States Antimony. This is a rare earth mineral play. They followed the momentum of like MP Materials. See, out of all the rare earth mineral stocks, this one is my favorite, I think, because they actually make good net income. They mine like zeolite and a bunch of different minerals for batteries and stuff like that. So they do own some rare earth mineral mines. And here's the best in Texas. And if we go down here, the revenue growth has been good. They did 8.7 mil of revenue, but check this out. Out of this 8.7 mil of revenue, oh, well, they lost net income, but I don't think they actually lost net income. Oh, they actually did. Okay, well, never mind. Well, before today, they were like barely making money, but at least they're barely losing any net income. I mean, they lost 5 mil this quarter. Their balance sheet just rocked. Did they dilute you to do that, or what happened there? Okay, they did dilute you by 35 million. Maybe that led to that probably why they're aggressively falling way more than like an MP Materials. But I like the sales growth, triple digit, but again, 8 million, very small. Someone said that website looks buns. Yeah, dude, their website was, very small company. They're only worth 820 mil. That might be a fair valuation, $800 million company for one that's, we really want to see them. Yeah, that was real. Their EBITDA, they were expected to make 4.5 mil of earnings before interest and taxes. Very generous number, but they lost 5 mil. So something just happened there. Yo, what up, Sean? Said Apple. Hey, let's do Apple. And hey, still remind me to look at Dell. I want to get to Dell. because Dell's super impressive, dude. We did a massive analysis on Dell earlier, and I was so impressed. Like, we spent extra time on Dell than normal, Ishwar. So I'll relook at them. I have some thoughts saved up on Dell for you. It's actually, I like them way a lot more than Supermicro Computer now. So here's Apple, a great never sell company. Oh, hey, we'll look at Anchor. Heck yeah, dude. I can't wait to check that one out. So here's Apple right here, pretty much all-time high on Apple. That's because Apple's been rewarded for not spending like crazy on AI and spending so much money on NVIDIA chips, like Meta and Google. They're spending like 30 billion on casual investing activities, but Apple's not. And most of that's just going to NVIDIA chips. So Apple's not buying NVIDIA chips and all that because they always do this. They're smart. They're late to the game always. Like they were late to the phone. They're going to be late to AI, but then they're just going to implement actually right now, here's what Apple just did. They have a $1 billion deal with Google Gemini. Apple now pays Google over $1 billion a year to integrate it with Siri. But they, as LLMs get cheaper, they just pick the best one and the cheapest one instead of them having to spend all the money right now. Okay, but anyway, let's go look at their core business because, iPhone sales are half of their revenue. They have been flat for a while. iPhone sales are flat since like 2022. But here's the thing. The most valuable part of Apple is actually their services business. So whenever you go spend money in the App Store, like you spend $100 in the App Store, they keep $30 of that as a platform developer fee, which is just crazy. Same with the Google Play Store. So they basically collect high margin services fee revenue, royalties. Then they have their wearable and accessories business, their Mac business, their iPads. And here's also why they're a little affected by tariffs. 36% of their revenue comes from US, 26, I always thought it was more than that. Then 26 EU, China 15, but they print net income. If we go to the net income, easily over 100 billion in net income a year. And since Apple, they're doing 25 billion net income a quarter. Since Apple isn't spending on chips and AI right now, they can just return it to the shareholder. So if you look at the top right here, they legit spend 20 to 25 billion dollars a quarter just buying back their own shares. And here's what that does for you as a shareholder. If you look at the net income, it grew 86% year over year. Again, there was a one-time adjustment this quarter. It wasn't actually 14 bill, but we can still use the comp rate. The net income grew by 86, but the net income per share grew by 90. Again, the EPS growth rate and the net income growth rate should always be the exact same. The only thing that changes this is the share part of the ratio. Is this they bought back their own shares, the less shares that exist, that makes the EPS grow more than the net income. And whenever the EPS goes up, that makes the PE ratio go down. It makes the cost of the dividend go down. It pretty much, in short, just forces the stock to go up. And honestly, Apple, they've been buying back $20 to $25 billion of shares just for eternity. Like even their share buybacks, they spent hundreds of billions of buybacks down here as well. It's so accretive to the stock, and that's why it just doesn't freaking go down on top of just a great business model. So yeah, a little expensive here, but I think there's cheaper Mag 7s, Meta's cheaper, Amazon's cheaper. Amazon's a great one. So let's do Dell right here. Oh, wait, actually, Anchor then Dell, 300866. So anyone know those like Anchor batteries, those Anchor products? Well, they're actually publicly traded. They're a Chinese company, but Anchor is really known for just making like high quality, like batteries. Let's see their website real quick. Anchor Innovations. Yeah, this is the company we're talking about. Yeah, like batteries. It looks like they're expanding into, that's really cool, like a solar powered camera, speakers, whatever Anchor makes, it's always just really high quality. So we'll convert the currency from Chinese to USD. Let's see. Revenue is up 18, and Christmas season's coming around. I bet Q4 is a really good year for Anchor around Christmas time. So revenue's up 18%. After it grew 49. That's a heck of a streak of growth. So the revenue's up 18 after it grew 49. And the net income, that's great net income. Easily, actually, and this is in USD, of course. If you average it out here, they're making close to 100 million of net income a year. And at this growth rate, they're going to be making 100 million net income a year. So it's really interesting. Top 10 shareholders own 77% of the company, but it's a great company. And if you just buy and hold the stock, let's see how much the dividend costs. They pay a dividend. So their reports will look a little different because they're Chinese, but they made 112 million net income this quarter. And if we go to the cash flow statement, it should be in here. There's a dividend in it. I don't know if we're going to be able to find it, but it says right here, if we go to the dividend payout ratio is of 52%. Notice the increase of the dividends. It was 60 cents. Now it's $90, $50, $2. So 2.5% yield on a nice battery quality. I don't know. Interesting. So let's do Dell right here. might sell all my super microcomputer to literally buy Dell. Oh, we got to look at Duolingo. I really want to do Duolingo. And I'm missing so many stocks like Astera Labs. I'm missing out on so many stocks. So I do apologize. Like Nick, hey, what up? He said IDXX, or give me the ticker symbol for that. We'll check it out and all this. What happens is, yeah, hey, and again, if you want to get this software I'm on, this actually this is a brokerage where you buy stocks on. If you want to get this brokerage, it's in the link tree in my bio, very first link there. It's an affiliate link too, full disclosure. So if you go and like deposit $100, we'll both get like a little free stock. But yeah, my favorite brokerage. It's literally free, costs nothing. So here's Dell Technologies. The PE is a 17. Like they always just trade at like a fair multiple. So a 15 or a 17 PE. Here's the best part about Dell. If we go to their infrastructure solutions group, this revenue had a nice year-over-year growth. It's up 44% year-over-year. It was 16 billion. Never a single quarter before today has even ever been close to 16 billion. So phenomenal quarter on their infrastructure group. But if we go to the client solutions group, looks like that's a bit of a slower grower. Yeah, comparing to negative numbers as well. So that might explain the lower PE. And it's a low margin industry. You know, Super Micro's margins just got collapsed. It's nearly the same as this, but yeah, low margin industry. But here's the best part. If we go to their net income, if you have easily, let's verify that. Yeah. Well, and this is after paying a billion plus of taxes. They're easily making $1 billion of net income every single quarter. So what is Dell doing with $1 billion plus of after-tax net income a quarter? Well, the dividend, they pay a dividend. The dividend only cost $366 million. And if you look at the last quarter, the dividend cost $390. How did the cost of the dividend go down? From the freaking share buybacks. They spent last quarter $2.3 billion on share buybacks, $1 billion on share buybacks this quarter. Here's what that does for you. The net income is up by 32, but net income per share is up by 38. They've bought back 6.2% of all the shares on top of paying a 1.56 or 1.58% dividend yield. They're so shareholder-friendly company. They're such a shareholder-friendly company they can afford it. So it might be reasonable for them to be at this 17 PE, but it's a good one to hold, I think. It's a good one to hold. Probably not with a lot of money. Like my super micro position, I don't have it as a major size position, but we still own them. So, okay. Hey, what up, Nate? He said 2 people asked for, all right, we'll get to this one. Let's see, what is this? Coherent. Hans said thoughts on Intel. Hey, Intel's interesting too. So this is a $22 billion company, Coherent. What does this company do? Is there any AI results here? Nah. Well, let's see. Data center and communications revenue. That's the industry you want to be in right now. Data centers, I guess, and industrial side of revenue. Well, let's see. So revenue beat on expectations. So they beat on revenue, they beat on EPS, and they beat on EBITDA. So it was a triple beat quarter. Yeah, they really did. So if we go to the revenue's up 17. And the profits are up by 73. They had some one-time adjustments to the net income. It looks so choppy, but you just look at the operating profit. This is the number before they pay that doesn't have the taxes, interest expenses, or the one-time adjustments in it. So you always want to blend the operating profit to the net income, or you could just look at the other number. But anyway, they're making like 150 mil of net income a quarter, which is good. So, and they paid a dividend. They just paid a dividend, I think. Interesting. Where does the revenue come from? North America's 61%. Actually, a lot of sales come from outside the US. Interesting. So let's get to app is in the link tree in my bio. Let's see. Okay, Duolingo. Then we'll try an Intel. Duolingo is being hurt by the AI thesis. So basically, OpenAI just created a language learning app competitor to Duolingo. Basically, Duolingo is that language learning app. People pay for Duolingo subscription to learn a new language, and the AI thesis are hurting them is like, you can use OpenAI's where you don't have to pay anything, or Google's has one too where you can learn one language app for free, no subscription. So. But this is specifically why I would buy the dip on Duolingo, not with a lot of money, but I'd buy the dip on them right now with a little bit of money as a nibble, not financial advice, but because the numbers aren't being hit yet. If we go to their subscription revenue, which is 85% of all their revenue, this is so impressive. There is no slowdown yet. Revenue's up 45. It grows 40 to 50% every quarter. Like if you look in the middle, just for eternity, it just goes 40 to 50% every year, every quarter. So phenomenal growth in the subscription revenue. If you don't pay for their subscription, you see a bunch of ads, and their advertising revenue grew all just positive growth rates in the middle. Advertising revenue's up 46 to a new record. So all the businesses are booming. Everything's headed in the right direction. Revenue's up 41. Profits were at 35 mil. They had a little one-time adjustment to the net income. It says they made 300 mil. They didn't actually make 300 mil, but they did make a record 35 mil, up 160%. Deleveraging balance sheets. So actually Duolingo, I would buy the dip on, but as a small position, not major size, because the AI thesis is still something to not just completely dismiss. Oh yeah, IDE. All right, we'll just type it in for you. IDE. Oh, it's IDXX. Oh, bet we found it. So IDEX Laboratories. Check that out. Yeah, new all-time high. Yeah, congrats. Yeah, up 5%. You know, this is a healthcare name. A lot of healthcare names hit an all-time high on Friday. I think like Johnson & Johnson did. HCA Healthcare did. Healthcare was on fire this week. Yeah, Eli Lilly did as well. So IDEX Laboratories, a $57 billion company. Let's see what they do. Companion Animal Group. Huh. I don't know what that companion animal, like a dog, or well, I actually want to look into that, but it's growing double digits. It's up 13%. Let's see, did that beat expectations? Yeah, big beat. They beat on revenue. They beat on EPS. You know, they expected $3.14. Well, they did $3.40, and they did triple beat quarter. There's no, you know, financials always explain why a stock is either doing really good or really bad. And, you know, it explains why this one's doing really good. They're triple beating on expectations every quarter. Yeah, the net income's up double digits, making 300 mil in net income a quarter plus. Let's see if there's any, where's the website again? Let's check out their website right here. IDEX.com. Creating clarity. We help pets live fuller lives by giving veterinarians the tools, technology, and insights to clearly get the answers they need. They probably have a lot of data, like a Zoetis too. So anyway, interesting little maybe pet healthcare, or I don't know, company like that. Yeah, congrats if you own them. You know, you got to be up. I just joined. Hope I didn't. Hey, what's up, user? Appreciate you, man. What's up? Oh yeah, let's get to Intel right here. Then we can get to Astera Labs. If remind me to get to that one. Oh, I have COHR and I'm up in Stanley. Oh, hey, nice Plasma. Heck yeah, I'm gonna buy the new C2000 Gen 2 battery inverter. You need it camping. Oh, hey, nice Looney. About to buy a huge battery pack from Anchor. Yeah, Anchor's amazing. So here's Intel right here. Intel unfortunately has not done too well. Intel is actually the same price that it was in 1998. So you bought the stock in 1998, you're flat on your position. But the reason the stock has been booming recently is because the government took a 10% stake into Intel. Nvidia took I think 5% stake into Intel. SoftBank did as well. The government kind of forced NVIDIA to do that. Basically, if you didn't know, NVIDIA just designs their chips, and all their chips, basically all of them are manufactured in Taiwan, which is 6 feet away from China by Taiwan Semiconductors. But we can't have that. So we're trying to be more manufacturing independent. Without the supply chain, like we need that supply chain in the US to be safe. So we're basically stimulating Intel to start producing. Like NVIDIA's eventually going to move some of their older series, like GTX 1080 chips, to Intel to manufacture their old CPUs. But yeah, I don't know. I wouldn't have this one as a big size position, but the government stake and the Intel stake, and I even think Apple might take a stake into this company. Who knows? Like there's companies like Apple, Meta promising like hundreds of billions, 300 billion in spending commitments to the US. One way they could do that is by buying just a stake in Intel. So again, I would have a huge position. Check out their GPU market share went from 64 to 61. It looks like they're losing their market share a bit. And if we just go to their net income down here, this was the government inflow of money, but they lose a lot of money. You know, if it weren't for the government stake and NVIDIA stake, we wouldn't even be talking about Intel. But yeah. So Astera Labs, let's do this one right here. Ooh, and was that O'Reilly Auto Parts? I really like that one. So here's Astera Labs right here. I love their numbers. Phenomenal company that deserves a high multiple. The forward PE is at 94. So here's the thing. Even after this little fall on Astera Labs, it might still be a bit expensive, but this is the kind of stock that deserves like a PE in the 90s or a really high PE. Check this out. Every quarter they beat on expectations. That's the orange line. They beat on revenue. They beat by EPS by over double. They beat by double on the net income and a big beat on EBITDA. So That's why they gap up so much on earnings days. Let's see if there's any is there like an AI overview of this? So revenue growth of 104% was driven by the Aries PCLE 6 solutions ramp up, strong demand for the Taurus Ethernet smart cable modules, and expansion via the Xscale Photonics acquisition. So a lot of English there. Gross margin maintained above 76% despite increased hardware shipments. So let's just go look at their numbers down here. Yeah, of course, they beat on revenue or beat on every metric every quarter. The sales are up 103%. The revenue's doubled. It's a triple digit every quarter. Look at the bottom. Year-over-year growth rates are triple digit every quarter. Revenue of $230 million. Out of this $230 million, they netted or they kept $91 million of net income on that. Oh, dude, this story keeps getting even better. This fortress balance sheet right here. Check this out. $1.13 billion of cash and no debt. And their cash isn't just sitting there doing nothing. They're actually earning interest on their cash. They made $11.5 million of interest on their cash. Pretty cool for Astera Labs. It's one of the more high quality names. 94 PE might be fair for them. I would nibble right here at probably this price. So CMG stocks. Steph said, please consider hit the like button. Hey, thanks, Steph. I appreciate that. Yeah, if you want to hit the follow button, hit the subscribe button. We stream every day. I'd greatly appreciate that. By the way, I sell nothing. Watch out for people impersonating me. I'll never follow you, DM you. I have no course book, WhatsApp, nothing like that. Sell nothing. So here's Chipotle. This is one of the restaurant stocks that are struggling. Just from the whole industry's getting hit. Like, it's not just Chipotle seeing this huge downtrend in stock price. It's all of them. Look at Wendy's. RIP Wendy's, all-time low. Or Wendy's is lower than they were in 1997. Same with Jack in the Box, same with Krispy Kreme, like Jack in the Box, same price as they were back in 2002. It's rough out there, but Chipotle's, if you're going to buy a dip on a, buy the guac dip, if you're going to buy the dip on a stock, a restaurant stock, Chipotle's is one of the better ones to buy the dip on, because if you go to their net income, they still print net income, easily $300 to $400 million net income a quarter. But look at this, the sales, the revenue increased 7.5. So the revenue's up 7.5, but the net income fell 1.4% because of the margins and the input costs. So their gross margins, have been declining. Their net margins down 8% year over year, and they've been missing on their growth expectations. They miss on revenue the past 3 quarters. And that's why I think the PE is now finally fair. Like a 28 PE is probably now fair for them. Yeah, that's right at the industry average, because before today, the PE was a 38, 60. Like they always trade at really high multiples. It's finally like back to reality. Another one I'm actually very much looking to buy the dip on is Wingstop. It's the very first stock we covered when we started this stream. But Wingstop, this one's really interesting because Wingstop is actually, a royalty play. Check this out. So it's like McDonald's. If you go spend $100 at any McDonald's, they keep $4 of it as a franchise royalty. So look at this, their royalty revenue, aka franchise fees, that's 46% of all their revenue, because they're actual corporate owned store and they don't collect royalties from those. Those are 20% of the sales. Let the franchises hold the bag and then you just collect the high margin royalties. That's why McDonald's is one of my top favorite stocks of all time. But yeah, they print money as well. Actually, McDonald's, I do own, full disclosure. I got 17 shares in them. They had a nice day on Friday. Okay. Bull stock. Hey, speaking of, let's do Bull. And then we'll get to, CAT. Yo, Cat. I know Looney is the crazy good on Cat. That's a great one. So Bull stock, actually, here's my Webull brokerage. I've probably given them a lot of transaction fees. I now actually own Webull in my Roth IRA. So we own, again, I'm more bullish than anyone on Webull, and as much as I'm bullish on them, I only got $400 of the stock. I don't want this as a super meaningful size position yet because it's right around fair valuation. According to my own math, this is my super generous PE. Here's a PE ratio that's generous. This company's trading at 35 times, like maybe even the year after. They're trading at like 35 times, or maybe even more, next year's net income, or 35 times next year's net income. So it'll probably fairly priced right now at this price. Not super undervalued, but fairly priced at its current price. So again, and here's why that's with my generous expectations that are more bullish than the already expectations. But Webull is this brokerage right here, publicly traded. It's this app. I've used their app for many, many years, and we've done terrible. Don't listen to me. We're only up 8.6% all time in this brokerage. But check this out. They just added, if you look crypto in the top right, it says new. They just added crypto back to the app and this prediction market stuff, where it's copying Robinhood successful results. They also have a bunch of other things like advisory stuff like Robinhood. So anyway, we're up 7x on Robinhood. That's what Robinhood does so well. They're copying their successful business model. So that's why I really like Webull as a stock. And I have a little bit of them. So let's do Caterpillar. This is like a heavy machinery kind of stock in so many different industries, like construction industry, resource industry, AI industry. Let's go check it out. So yeah, energy and transportation. Check this out. Actually, look on an annual basis. Good revenue growth there. The construction industry, resource, financial products segment. But anyway, if we go to the PE ratio on this company, they trade at 25 times PE, which is pretty fair. At the end of the industry average, they definitely deserve a slight premium to the industry average because they're Caterpillar. 25 PE on Caterpillar. If we go to their net income, they're easily making 2 to 3 billion in net income. It's tough. It's slowed. The net income is slowed, but the PE is still fair and it's expected to grow back. But they're making easily 2 billion plus in net income a quarter. What are they doing with all that? Well, if we go to the dividend only costs 700 million a quarter. So what are they doing with all their leftover money? They're legit doing massive share buybacks as well. Spending more on share buybacks, double on share buybacks than they are on their dividend. And you get a good yield. Yeah, an over 1% plus dividend. They raise their dividend every single year faster than the rate of inflation. You've gotten your yield on cost is much higher than 1% because, whenever a stock goes up, it makes the yield go down. So you probably have a great yield on cost and it's going to continue to grow. They're a good stock. And I certainly wouldn't sell them. They're multiple, even after the net income's fallen, after the stock's gone up, the P ratio is still fair on that one. Do you trade? No, I mainly just buy and hold. Sometimes I'll do a swing trade for like something, but I don't day trade or, let's see here. The user said, can we do GNS stock? All right, let's see this one here. Genius Group. Okay, actually, we're not going to cover this stock, or sadly, if you look in the top right, the whole company is worth $50 million. Like this whole company is worth 50 mil. It's a micro cap. It's a penny stock at 60 cents a share. So these are the kind of stocks that just go to zero usually. Yeah, they don't have any sales right now. Or, this is from 2022. So they're a revenue-less company. They have no sales. So you can't really, we won't spend any more time analyzing them. Sorry. Would not recommend that one. Just because there's no fundamentals there. There's no financials I can even analyze. So let's see here. Oklo, that's a big, I just don't buy these kind of stocks. Here's Oklo right here. If you're wondering, first off, this is super speculative. This is an SMR play, small modular reactors. They're making these. If you didn't know, there's only 3 working SMRs in the world. None of them are in the US. The first US one to come online is in 2030. This is just a nuclear momentum play that just, you buy it for the momentum. You would never buy and hold this stock, in my opinion. You would not buy and hold this one for the long run. This is a pure something to swing trade and do options on or something, because right now there isn't going to be no revenue for a long, long time. So if you go to the revenue right here, it says no data because they've never sold anything, not a product or service. They lose 50 mil a quarter. So that's just because they have no revenue. Wouldn't buy that one. If I wanted a real nuclear play, the best nuclear play with real assets, with still so much upside potential, I think is CEG, Constellation Energy. This is the largest pure play for nuclear energy. They own 30% of all the US's nuclear reactors. We got a little dividend coming in from them. But yeah, hey, actually, this is known as our dividend-only portfolio, where every stock in here pays a dividend. But as you can probably tell, most of these are like dividend growth companies. Well, let me show you check out the dividends. CEG, Carlisle, United Rentals. Yeah, a little bit of dividends. Okay. Hey, shout out to the homie Brian Paul, the member. What's your take on I don't know what that is. INVIVYD. I don't know what that, I don't know what that is. Hey, Spaceman, is that a stock there? Let me know what you're talking about there. Is that the ticker symbol? INV? I don't think we're going to find that stock. There's no way this is going to pop up. We found it. Oh my goodness. This is it right here. Okay. I found it for you. We'll look at Toast after this. And then ABF, we'll look at all these. Hey, what up, Tommy, Brian? Good to see y'all. So this is a $690 million market cap company. You're right. Very small market cap. Let's go see if we can figure out why. So product revenue revenue this quarter was 13 million. So they did 13 million of revenue. And on that, they lost 10 million. They're losing around 10, 15 million a quarter, but that's certainly a big a big step in the right direction from the same time last year. Look at that. They used to lose 50 mil a quarter. Now they only lose 10 mil a quarter. So they're narrowing their losses, which is great. But still, this is really bad. They're losing 10 million a quarter, which is 40 million a year. When you lose 40 million a year and your whole company's worth 700 million, that's not great. And, that's just this year. The year before, they lost, over 200 million. They lost 200 million that year. And again, the whole company's worth 700 mil. So that's why I could see why before today, this stock is at an all-time low. It's a lot to bet on. So certainly one I wouldn't really have as a meaningful size position. There are some things there that don't show it's the end of the world for that one, but they're probably in a small position. Let's do Uber. Oh wait, Uber. Got to do Uber stock. I saw that one spammed a few. Hey, what up? What up, Fork? I hope you're having a great day, Fork. And Net Prime, good to see y'all. So here's Uber. This is one of my favorite stocks to buy the dip on right now. The PE is so cheap. The PE right now says it's 10. You don't look at the current PE. They're trading at 24 times next year's PE or next year's net income. That's what I love about Uber. I'm going to give you my bull case on that. This is a great never sell stock. If you go to Uber right here, they have 189 million monthly active consumers. Not just monthly active users, but monthly active consumers are 189 million. Really good. Like their delivery business, which is Uber Eats. That's up to a new record, up 30% after it grew 18%. But here's why we also don't look at their current PE ratio. If you go to the net income right here, it says they did 6 billion in net income. They only did 1.1 billion, but still easily over $1 billion a quarter, which is great. And where was this other thing? Oh yeah. Grab has been taking stakes into a bunch of other different companies. Like another cool thing is ticker symbol Grab right here. If you're wondering what is Grab stock, this is literally international Uber. They do exactly what Uber does, but literally in all these other countries where they're not in the US or Canada or UK. So if we go to the largest shareholder of this company, it's Uber. So Uber owns 13% of all the shares here. So basically 13% of this revenue, 13% of 4 billion a year goes to Uber now. All right. Yeah, I really like that one. So ABF, hey, wait, Brian, he said ABF.L. British Foods or ABFL? I don't know if are you talking about this ETF right here? This is an ETF, which is just a basket of stocks. Let's see what it owns. Looks like it owns Apple, but notice only Apple's 5% of it. In the S&P 500, it's like 8-9% of it. Then it's Nvidia, then Apple, then AbbVie. I really like that. I love AbbVie. Then MasterCard, and then some other like healthcare names. It's like interesting there. Okay, I want to get to Micron as well. So here's Walmart. Walmart reported earnings just a few days ago. Or let's see what the earnings hub says about Walmart. Let's see what they did. E-commerce grew 27%. That's really good. Sam's Club contributed to overall revenue growth. Gross margins improved slightly. Hey, that's good. Let's go check out their numbers. So yeah, they beat on revenue. They beat on EPS. Yeah, they expected 59 cents. They did 77. And they beat on EBITDA. So it was a triple beat quarter. No wonder Walmart was up, 5% yesterday on the day. They print net income, easily like 5 billion plus of after-tax net income every quarter. Then they also reward you a little bit with the dividend. You get a near 1% dividend. They do little share buybacks. They have one of the most valuable real estate portfolios in the US. Sam's Club, I like that business. You have to pay a subscription to get into a Sam's Club. Whether or not you go, you still pay them their subscription. And yeah. So let's do Micron right here. Then we'll get to Murphy. Yo, Murphy's my favorite oil and gas play right now. So, hey, what up, Craig? We'll look at SCHX and some of these other names here. Oh, and Toast, dude, UZG. I am so sorry, man. We're looking at Toast next. Here's Micron Technology. I actually would not sell out of this company. Not financial advice. Even though the stock has done so great, you would be dumb to sell this name. I think these are the kind of stock that's just going to continue to go higher. It's going back to 260 eventually, unless NVIDIA just collapses. But the PE ratio on this company is a 27. And that is industry cheap, and they have just as good growth rates comparable to NVIDIA and AMD. Or like, check this out. If you go to the revenue right here, the sales are up 46% year over year after they grew 93% year over year. So incredible top line growth, and not just top line growth, but also bottom line growth. They netted 3.2 billion net income. That's after they paid, 500 million taxes. Like that's real. They made 3.2 billion net income, and at this growth rate, imagine 3.2 billion every single quarter. 12 billion net income a year, which in the market cap's 2 cents. The forward PE they say is a 13. Wow, certainly wouldn't sell out of this one, and they have a nice dividend growth they'll have too. So actually, I do really like Micron. That's a really cheap forward PE. So let's look at Toast right here, then Murphy. Well, that's a cool one. So Toast I actually do own, and Toast is really struggling because restaurants are struggling. And yeah, we have 15 shares of them. We're down we're down 12% on our shares, so you could get in at a lower cost than me, but they're still expensive, quite expensive. They trade at 48 times next year's net income, but they just basically got net income positive, and this is one I truly believe in. They're a restaurant payment processor, point of sale system. If we go to the revenue, this is really good. The revenue's up 25, after grew 26, after grew 38, after grew 58. Like, they're on a streak of growth. Like, that's what you want to see for a stock. Like, actually, let me look at this up here. Actually, it's not going to work well. Anyway, the revenue growth is insane, and not just the revenue, but now the bottom line. They're now making they made 100 million net income this quarter. They used to lose net income every quarter. They used to lose like 100 million net income a quarter. Now they're making consistent net income a quarter. And again, they're basically first year ever profitable. They expect the net income to grow significantly faster. So really good balance sheet, deleveraging their balance sheet like crazy. I think they have so much net cash, they're earning interest. So check this out. If we go to the cash, look at the cash. It went from 1.27 to 1.86. What are they doing with their cash since they have no net debt? They're earning interest on it. So if we go to their interest right here, they made 13 million of interest just on their cash. So that's why the operating profit was higher than the net income. Pretty fascinating. And the free cash was really good. So anyway, I really like Toast. Valuation still might be really expensive. And their core customers in business are restaurants, and they're all struggling basically. Chipotle, Wendy's, yeah. Walmart repriced to NASDAQ. Make sure people know it's included. Oh, hey, what up, Chris? I didn't know that. Murphy. Let's get to Murphy. APLE. I think that's Apple Hospitality, or we'll check out them. So here's MUSA. This is my favorite oil and gas stock out there. So actually, I want to show you it over here because it's so cool. So if you look at any oil and gas stock right now, they're all struggling just because the price of oil. So, and they're not immune. If we go to their revenue, it's down 2% after it fell 9%, but they're making easily 100 mil plus a net income a quarter. Here's the best part about Murphy USA. First off, they don't suffocate themselves with a high dividend payout ratio. The dividend is 10 million a quarter. Again, they're making 100 mil plus easy, sometimes 200 mil when oil is higher, but they're making 100 mil a quarter. The dividend only is 10 mil a quarter. So what are they doing with all their leftover money? 100 to 200 million on share buybacks a quarter. The bottom here is what they're spending on share buybacks. So if we go to their total common shares outstanding, this is the best part. This is total common shares outstanding. Where is it? Yeah, right here. Total common shares outstanding. They've bought back 17.5% of all the shares. After they bought back 5% of the shares. After they bought back 8% of the shares. After they bought back 11% of all the shares. After they bought back 8% of all the shares. I kid you not, look at 2018. There was 32 million shares or 32 mil shares. Now there's 18. They've bought back over 50% of the company just since 2019. So anyway, this is a shareholder-friendly company if I've ever seen one, and that's why they deserve to go, in my opinion, in my buy and never sell portfolio. I want to expose you to oil and gas. And again, most oil and gas stocks don't do well because they suffocate themselves with a high dividend payout ratio. But I think one of the reasons is this one's done quite a bit better than your average oil and gas stock is because they don't suffocate themselves and they do share buybacks. So that's why I like them. Again, the stock's not done too well. They're not immune to the price of the oil doing bad. But whenever the price of oil goes up and oil rebounds, I think this one's just going to slingshot higher. Okay, again, as much as I love them, as much as I love this stock, they're oil and gas related. You don't really want this as a huge size position in your portfolio. So yeah, we only own 4 shares of them, but I'm super happy as a shareholder. No one really did. They're a spinoff from Murphy Oil. So APLE, this is Apple Hospitality REIT. I'd rather buy like that's the triple net lease for the hospital. So they own the land under the hospitals and the hospitals pay them every month. I'd rather own the hospital groups. I actually own ticker symbol HCA Healthcare. But here's Apple Hospitality. You're buying this to maximize your dividend income. If you go to the dividend yield, what is it? Wow, an 8.17% dividend. So that's a really good dividend. 8.2% dividend yield. Let's go see if they can afford it. So what you look at the cash from investing activities, or this is called the core FFO. We can kind of understand why this one hasn't done so well, because there is some, for the past 4 quarters, it's been declining. It's negative. But this is what you do the dividend payout ratio from. You don't look at the net income for REITs. But they made 126 mil this quarter, actually 49 mil 2 quarters ago. See how much the dividend cost. The dividend cost 56 mil a quarter, or 50, 60 mil a quarter. So it's not the end of the world, just not an asset I see outperforming the S&P 500, but I gotta do more research on them. I haven't done too much research on them. Thoughts on MELI? Never seen a stock price so high for a company under 100 billion. Yeah, this isn't a US stock. Actually, another one is Booking Holdings, like BKNG. And normally they do like reverse splits. Are they worth 100 billion yet? 150 bill. Yo, if anyone's ever heard of Booking Holdings, first off, I'd put it on the watch list. We're not going to talk about them, but I'm going to make a video about this. 19 forward PE. This is a royalty play. I kid you not. If we go to their gross margins, basically 100% gross margin. Anyway, or MELI, this is like I think Brazilian, actually, wait, that was old numbers, never mind. So anyway, here's Mercado Libre, or whatever this is, a $98 billion company. What's the forward PE? A 37. So 38 forward PE pretty much. But yeah, they're like the South American Amazon, 55% of the revenue is Brazil, and then 23% is Mexico. And then Argentina is 18%. So, you don't see the US or anything on there. So, they're a commerce play, financial services, and income. How's that doing? Actually, let's go see what the AI earnings review has to say, because I actually don't know too much about this company. Let's see. So, commerce segment saw total payment volume rise of 48%, gross merchandise volume of 28%. Fintech business expanded with monthly active users increasing 29%. Credit portfolio growing 83%. Cost efficiencies improved with 8% reduction in unit shipping cost in Brazil. Operating cash flow surged 85. Did it? Yeah, look at that. Wow. What did that do to the free cash flow? FCF down here. Yeah, 2.6 bill of free cash flow. This is in USD. Yeah, they're making easily a couple hundred mil in net income a quarter. Actually, like 500 to 600 mil in net income a quarter, which is 2 billion plus in net income a year. And it's good. Yeah, so 38 forward PE. Interesting. What is your risk management if there is a recession? Well, I just buy and hold high quality stocks that I'm ready to buy even in a recession. Like I have I have a lower risk tolerance than probably the average person. Like I buy risky stocks, but I buy risky stocks that have good financials. Like I don't touch any risky stocks without like some sort of good reason or good financial metric reasoning behind it. Yeah, I definitely own some. I keep the backbone of my portfolio to the S&P 500 and the S&P 500 names. Like I keep the backbone of my portfolio in Meta, Google, Constellation Energy, Amazon, these great names. And then I'll put a couple hundred into some of the risky names like Webull, Cormedics, and Innodata, and Toast, and Axon, and some of these other names that I find fun that are certainly interesting. Like, because you want some of these small names, like Reddit. I paid a ridiculous valuation at the time, but it's paid off. SoFi, Robinhood. I bought Robinhood when they were losing like 500 mil in net income every single quarter. But okay. Oh, AppLovin. Let's do this one. I love AppLovin. That ABFL ETF looks interesting. Yo, ABF. Yeah, hey, unfortunately, Brian, I tried to find that one for you. It looks like this brokerage just doesn't let me view ABFL, or maybe there's a different ticker symbol for it, because usually there's a different ticker for it. I can't. Actually, I'm going to type in that name for you and see if we can find it. Hey, shout out to because you remember, Brian, I got you. Let's see. British Sugar. I probably won't be able to find it. Yeah. Sadly, I can't find it. Oh, it's on the LSE though. Oh, okay. So let's look at AppLovin right here. They just got added into the S&P 500. They're also being investigated by the SEC for their data collection practices. Their ads are so good that the SEC has got to investigate them. This stock is one of the most impressive stocks I've ever seen in terms of financials. Incredible, flawless fundamentals. Check this. Like, it impresses me. Like the revenue is up 68%, but notice the revenue. The total sales were 1.41 billion. Out of this 1.41 billion of revenue, 840 million of it was their after-tax net income. After they paid 160 million of taxes, they kept 83 million of that, which is the same as a 60% net margin. That's insane. A 60% net margin after paying all the tax and the free cash flow as well. The free cash flow was up, it's doubled to $1 billion of free cash flow, 900 mil of net income. Like they're going to be making $4 billion net income a year. So yeah, that's why the current PE is a 63, but the forward PE is a 38, just because there's so much future growth expected for AppLovin. This is one I would absolutely love to own. I really want to own this one eventually, just at a more reasonable valuation. They have like a Palantir type. Well, actually, no, not a Palantir type valuation. That 40 PE wasn't nuts. Great stock. Do you use absolute valuation to calculate? No, or not. I kind of just do my own little analysis. I blend so many metrics in together to kind of get to make my own little valuation there. What did I just click there? Let's see here. Innodata is interesting too. What's your opinion about HIMS? Let's do HIMS right here. What up, good time? And thanks, Net Prime. I appreciate that. Hey, we'll try and get to Iris Energy. Google will win the AI race. Yeah, Google is already beat OpenAI at their game. Gemini 3.0 is already better factually than the best versions of ChatGPT. So that actually came out 2 days ago or something. But anyway, let's look at HIMS. Then we'll actually get to Google in a little bit too. We'll try and get to all these stocks here. And my apologies if I missed some of these. Some stocks I can't get to just because, okay, but here's HIMS right here. Actually, they have a nice subscription business. If we go to their total revenue right here, the revenue increased 49%, surpassing estimates. But that was fueled by a 50% rise in online revenue. So their online sales, because I've seen some of their products in person before. But they have but this is the best part, a 21% subscriber growth to 2.47 million subscribers. So people are paying. But the company completed a $258 million acquisition to expand into European markets and launch hormonal health products. I know they were doing some testosterone kind of stuff like that. But anywho, one reason investors are a bit spooked is because they used to sell Ozempic, they used to sell a weight loss prescription on their website for like for a good monthly price, and that's what led to a lot of their net income and their really high margins, was the fact that they were milking so much on their weight loss prescription. But now Novo Nordisk abruptly ended their partnership with Hims and Hers, and now they're selling another GLP-1 prescription, but it's at half, like they make not anywhere near the same profits as they did before. So it's kind of the future uncertainty of the net income and EPS is why Hims is a bit struggling right now. Yeah, so look at that. The net income is basically supposed to be flat for the next year. Yeah, the current PE is a 65. The next year's net income, they're trading at 62 times next year's net income. And that's not great. The net income, what it is right now is really supposed to basically be what it is the same time next year. So that is explaining why the stock is probably slowing down. And again, that's an expensive multiple. 62 times next year's net income. Him sadly might fall a little more. Who knows? But top line growth is really impressive. Revenue's up 49. Let me get my water here. Sorry. The revenue's up 49% after it grew 77. Like after that grew 56. Top line growth is super impressive, but it looks like the margin. Yeah, that was actually the core business. They only made 11 million in net income this quarter, and that was like real. So that's right. Yeah, like they beat on revenue, but yeah, a big miss by over 50% on their net income. Hey, shout out Tangrika. How are you today? Is Apple still a good investment now that Warren Buffett take out a large amount and put into Google? Actually, Buffett barely sold any. So first off, if Buffett sold all his Apple position, it wouldn't bother me because I love Apple. But yeah, we can go to Warren Buffett's latest changes. If we go to Apple right here, he sold 42 million shares of Apple. This is why it's a big nothing burger. It's literally still 23% of all his portfolio. And now if we go down here, 1.9% of his portfolio is now in Google. He bought Google for the first time ever. If we go to new right here, Google is the newest position. I noticed a lot of supervillain, even Nancy Pelosi, her largest holding is Apple. Warren Buffett, largest holding is Apple. I think Soros, or not to get Trump, besides his company, his largest holding is Apple. Soros portfolio, his largest holding is Google. Nvidia. Okay, anyway, what was I wanting to look at again? Oh, is Apple still good to invest in? Absolutely. Actually, well, not here. Huh. The valuation's definitely high here, especially compared to other Mag 7. Meta's way cheaper. Amazon's way cheaper. Microsoft's way cheaper than Apple, which is crazy to say. Apple's the most expensive. Honestly, I'd rather buy Microsoft right now over Apple. But Apple, the reason they're at all-time highs and are doing so amazing is because they're not spending on AI. Microsoft, literally all the other Mag 7, well, not Tesla and NVIDIA, but all the other Mag 7 are spending crazy amounts of money on AI, and most of that's just going to NVIDIA chips, and Apple isn't at all. Apple, they always do this. They're late to the game. They were late to the phone business, but then they make the best version, the most innovative product of it, and then it sells the best. So Apple now pays Google Gemini over $1 billion a year to implement it into Siri. So Apple just goes, they let other people spend all the money and then just kind of rent it and do the best thing. But anyway, yeah, iPhone's half the revenue. The most valuable part of Apple is actually their services business. Whenever you go spend $30 in the App Store, whenever you go spend $100 in the App Store, they keep $30 of it. They have a 30% royalty on every sale in the App Store that happens. They keep crazy high margins, and they have the Mac, iPad sales, all that. And they print net income, 25 plus billion of after-tax net income a quarter. So 100 plus billion net income a year, just great. It's a great never sell stock, plus all the buybacks. So hey, James said BULG. Oh, this is the 2x leverage daily. Oh, Webull ETF. That's actually pretty interesting. 2x long Webull ETF. So actually, I just own BULL. Honestly, Webull is so volatile that you don't even need to buy like the 2x version of it. I would just buy normal shares of Robinhood because it's already down. Since IPO, not even year to date, like not even like they're already down 50% or down 40% in 3 months. I think it's worth just buying normal shares. Again, not as a huge position, but very small. What was the app that shows those investor portfolios? Oh, yeah. Hey, by the way, this is actually a brokerage right here. All these apps are brokerages. This is my favorite one right here. It's a software where you buy stocks on. It's an affiliate link full disclosure. So if you go and deposit $100, we'll both get some free stocks. But yeah, if you want to get this app, it's in the link tree in my bio. Very first link there. All the apps are. All these are brokerages. Or you can just go to Google and type it in. Broker called Moomoo, Webull, Robinhood. They're all there. So anyway, I do like Apple. Currently writing an essay with Gemini 3. Hey, what up, JV? Thoughts on quantum computing? Yeah, I wouldn't buy any of the individual quantum names. They've all got crushed the past week because there's no fundamentals. There's no fundamentals to justify their market caps. So if you're going to pick a quantum name, you'd pick either Microsoft, Google, Honeywell, or IBM. You don't want to pick Qubits, IONQ, QUBT, Rigatoni. This was originally like a pasta maker, actually, I believe. That's why people call them Rigatoni, but I wouldn't really touch any of these. I would buy Google Micro. Like look at RGTI, for example. Crazy momentum, no financials to justify it. So this is why the stock just gets crushed. There's no business here. I mean, the revenue is 1.9 million, down 18% after the sales fell 23. They lost 200 million in net income this quarter. But they have been able to take advantage of this rally and dilute you as a shareholder. But anyway, yeah, none of the quantum stocks. I wouldn't own anything with meaningful. Hey, someone with Xylem. Hey, what's the ticker symbol for Xylems? Give me that one. We'll check it out. Bought some CRMD last Friday. Hey, nice UZG. CRMD is one of my favorite names to buy out there. But as much as I love this one, and I think it's a 3X, you cannot, I really mean this, you cannot have it as a meaningful size position. Like I got $750 of it. I will never get over 100 shares of Corematics, I don't think. Unless it just absolutely tanks. But there's a lot of risk with that one, but I love them. So let's look at MasterCard. Oh, remind me to get to MasterCard. I want to get to that one. So Jazz Pharmaceuticals, let's check this one out. FIA has dividends every 2 weeks. What up? Oh, QuantumScape? Yeah, their subscription revenue just plummeted. Actually, we'll check out QuantumScape too. But here's Jazz Pharmaceuticals. They're a $10 billion company. Actually, they've done really good. They're the same price as they were. Oh, actually, no, they haven't. This is on the monthly chart. Wow. I thought this was like an IPO in 2018 or something, but no, this goes back to 2007. So Jazz Pharmaceuticals is the same price that it was back in 2014. So you bought the stock in 2014. It's the same price that it is today, but some sort of good news here. Let's go look at their earnings because there was some sort of good news. Insider sale or I'm trying to find news here. Says Zehira is a pipeline in a Zymeworks shift to a royalty-driven. Okay, well, let's just go look at their numbers because that's what matters here. So, identification, development, and commercialization of meaningful pharmaceutical products. Okay, 89% of the revenue comes from the U.S. So they beat on revenue. They beat on wow. So they expected 250. They did $4 of EPS, but they did miss on their EBITDA. I don't know. I wish I'd give you some more thoughts on this one. I don't know much about that one. Actually, maybe we can click really quickly. Zip code is 4. Oh, they're in Ireland, so this is not a U.S. listed company. So looks like some sort of pharmaceutical, yeah. So, all right. Hey, Tangrica, I didn't even see that. Yo, Tangrica with the hat and mustache. No way, Tangrica. Thanks for that gift there. I really appreciate that. Yo, if you got another stock you want to look at, definitely let me know there. So QuantumScape, this is like some subscription model company, I believe, or I'm maybe thinking of a different company. I am thinking of a different company. Yeah, wait, QuantumScape. Yeah, QuantumScape. This is that rare earth mineral play where they have this rare earth mineral mine, but it's still not open yet, and it's still not making any money. If we go to the revenue right here, it says 0 because they've never sold anything. They've never sold a product or a service. They're not really expecting to in the next 6 months either. But if we go to their net income, this is the tough part. They can afford it though, which is the good news, but they're losing like 100 mil plus a net income a quarter. And they just diluted you by 300 mil. Oh, Porsche Automotive, Porsche owns 14% of all the shares. Largest shareholder actually. But we really want to see them start to make sales. So yeah, they have like a lithium mine or something like that. I don't know. It's developing next generational SSD metal batteries, or maybe they're I really don't know. Maybe they're not the people who own the mines or whatever. I don't really know, but they have no revenue. So you want to be careful with it. There's some other it's like 2 ticker symbols like that where it's like quantum something, or I don't know, some sort of subscription model company like that. Do you think O'Reilly's is a good buy? Absolutely. O'Reilly's, well, not here. Well, 31 PE. They deserve a 31 PE. So this is O'Reilly, recession resilient company. Even in a recession, you got to go get your car fixed or get a new battery, fix the tire, whatever. They make a consistent stream of net income, easily 700 or 600 to 700 mil in net income a quarter. And O'Reilly has a rule where they return 50% of their excess profits to the shareholder, not via dividends because they don't pay a dividend, but via share buybacks. This is the sole reason O'Reilly never goes down and why I love this stock. And I love this name. Same with AutoZone. If you look at the top here, they spend 400 to 500 mil a quarter just for eternity on share buybacks. So if you go to the total common shares outstanding, every quarter, every year, it just ticks down. They don't have looks leveraged, but they could easily afford to pay off all this debt in not too long. But they're especially because of how much they're spending on buybacks. They have so much leftover money. I love O'Reilly. I'd probably wait to get in lower, but that's a stock just like AutoZone. They do so well because of all the buybacks they do. Hey, what up? Chris said QTUM ETF is the best of them all. What is their top holding? Wait, is that actually the ticker symbol? Let me see if I can find it. Hopefully I'm not lagging here. Quantum Defiance ETF. So we go to their top holdings. Tower Semiconductor. That's only 2% of their portfolio. Riggedy, Micron, Teradyne. Teradyne's a robotics play. They actually the robotics division was real impressive, still super expensive. I wouldn't buy that one yet, but Coherent, Google, Lam Research. So it's not just a bunch of junk. At least they have some okay names like AMD, Google. So yeah. Now you're right. I'd rather pick that ETF than a lot of those bad stocks. So they got some great trial results last week. An interesting one. Oh, that's the news because they actually, when we're looking at them, they gapped up 2 days after their earnings report. So that was interesting. Yeah, let's go for IBM because IBM's another cool quantum play, but that's just one little bet of their business. IBM has had this amazing stock price appreciation while also giving you a great dividend. You've gotten a 2.2% plus of your money back every year via dividends and the crazy, S&P 500 performing stock price appreciation. So if we go to earnings hub, so software revenue grew 10% year over year. Infrastructure segment saw 17% growth, led by strong demand for their Z17 mainframe platform and hybrid cloud solutions. Consulting revenue increased 3%, though prior quarter signings declined, raising concerns about backlog stability. Okay, so it's like overall was a good quarter though. Yes, I like how diversified that they are. 44% of the revenue. Software, consulting's 33%, infrastructure's 21%. U.S. is only 40% of the business. Other countries are 60%. But they make great net income. They had a little one-time adjustment this quarter. They never lose net income. Every quarter, they're easily making, on average, call it $2 billion of net income every single quarter, which is good. And that's how they can afford the dividend. If they're making $2 billion net income a quarter, the dividend, that's a bit of a high 75% payout ratio, but dividend cost $1.5 billion in net income a quarter. So yeah, the dividend payout ratio is around a 75%. Okay, hey, what up, Han? Let's do Palo Alto Networks. I love Palo Alto. That's also in the Nancy Pelosi portfolio. Nancy Pelosi does own some Palo Alto Networks, and they fell. They need to get back to reality in terms of valuation. I'm telling you, this is my favorite cybersecurity play. I love cybersecurity. I love CrowdStrike. I love Palo Alto Networks even more. I want to own this one, but they traded 86 times next year's net income. Like it's 86 next year's PE. Right now, his PE is like over 100. So it's just still, even after this dip, too high of a valuation for me to pay. But I'm telling you, they're at the top of my watch list. Like I really want to own this one. Like this is the kind of stock that deserves a high multiple. If we go to their subscription model, so I love subscription model companies. It's all reoccurring, all predictable. It just hits a new record every year, every quarter. Over half of the S&P 500 are customers. And cybersecurity isn't getting hurt by the AI thesis. You look at Salesforce, Adobe, they're really getting hurt by AI, like Duolingo as well, but not Palo Alto, because cybersecurity should only benefit from AI and hackers getting better with AI. But yeah, product revenue, yeah, it's at a new record as well. Everything's heading in the right direction. Printing a couple $100 million, $300 million in net income a quarter, free cash flows, $500 million to $1 billion quarter. I love them, but still, that value, next year's valuation is still too high for me. But I love them. All right. Hey, what up, Stocks Crypto? Yeah, QTUM is certainly really interesting. I really like a lot of those holdings. Can you reverse Tesla or review Tesla, or is there like a reverse Tesla ETF? Let's look at Grab. Hey, what up? Let's look at Grab real quick. Then we'll get to Tesla and LEU. That's actually, LEU is one of my favorite uranium plays because they actually have good numbers. So yeah, and we'll get to Netflix. So I want to get to all these here. Sorry if I don't get to all these stocks here, but here's Grab Holdings, a $20 billion company. If you're wondering, what does this company do? They do the exact same thing that Uber does, but not in the US. They're international Uber is what I call them. Malaysia, Indonesia, Singapore, Philippines. That's where all the revenue comes from. The US, Canada isn't on here. And if we go to the largest shareholder of this company, this is also what's very genius of Uber to do. It basically gave Uber instant international diversification, but Uber's really going to help out Grab. Their interests are aligned. Uber's the largest shareholder of Grab. There's no one else more to benefit. So they own 13% of this company. So basically 13% of all the revenue goes to Uber. But I love this company. Really growthy. The top line's really growthy. They're making net income every quarter. Analysts are expecting the revenue to go to 940, basically $1 billion of revenue a quarter. We know this commodity works. We know people want ride sharing, and we know people want, I guess, stuff delivered to their house, like whether it's food, groceries, whatever. So it makes sense. Like this is the international version of Uber, the commodity. So anyway, pretty cool. Probably wouldn't have any. Actually, what's their forward PE? They're probably expensive still. Let's see. Forward PE is 60. So 60 times next year's net income. But again, they literally just now got net income positive. So you really want to do like a 2 or 3 year out PE multiple to be really fair with them. But I really like them. Let's see here. Hey, what up? Yeah, hey, BlackRock. I love that one. Actually, we were just looking at BlackRock and they removed it. BOK is going into my safe, never sell stocks. McDonald's, Waste Management, BlackRock is another one that I think. This is an asset manager. So if we go over here to what they manage, they're an equity, fixed income, alternatives. Actually, this is their crypto ETFs. It's triple digit growth this quarter, 830 million. That's a record. It's never even been close to that before. So they're Ethereum. So their alternative ETFs like crypto and Ethereum, that's what's leading to that growth. Investment advisories, they're so diversified, like cash management, all really growthy. So If you go to their net income down here, they're making phenomenal net income. Easily 1.5 billion plus of net income every quarter, but and a 2% dividend. Let's go see how much the dividend costs. If that payout ratio is right, the dividend should cost around 600 million a quarter. Let's go see how much it costs. So the dividend, okay, dividend cost 850. Oh, they just rose this. So the dividend cost 850 million in net income a quarter, which they can still easily afford. But yeah, hey, anyway, BlackRock, I love them. And the PE, what's a forward PE? 18. Wow. Probably 20 PE, but yeah, I like them. What about Nvidia or Netflix? Let's do Netflix right here. I really like Netflix. This is a subscription model play. Everyone has like a Netflix subscription, but the valuation is still too high for me to pay. What's the PE on this company? 44 PE. That's fair for Netflix. Netflix always trades really expensive like this. Normally they trade like 50, but here's what I love about Netflix. They just did the reverse, but the stock used to cost 1,000 a share. Now it's only 100. But they have 300 million premium subscribers. Their ARPU, average monthly ARPU is $11.69 per user per month. And look at this net income. This is the best part. They're printing 2 to 3 billion of after-tax net income a quarter. Same with FCF, which is free cash flow, 2 billion to 3 billion of free cash flow every quarter. So the gross margins. 50% gross margins, nice. And actually, the margin slightly went down because of a one-time Brazil tax charge. Actually, funny thing, go to this right here. I was looking at this story. They have never paid taxes in Brazil ever, but this says their operating income increased 12%, but was affected by a $620 million Brazilian tax dispute. So they had to pay their backlog taxes over there. No biggie. It was a one-time adjustment. I love Netflix, but valuation still might be a little too high to pay right now, but they're really on my watch list. They're a great subscription model company. Like a lot of people would cancel Netflix last out of all their stuff to cancel. Let's see. Hey, what up, Suzuki, man? Good to see you, homie. Hey, Raphael said, hi, I'm from Jamaica. Hey, that's awesome, dude. What do you think about physical gold ETFs? Yeah, out of all of them that exist out there, my favorite one, a lot of people know IAU, which is the iShares BlackRock one, and GLD. But here's a little life hack for you I recently discovered, or someone in the chat actually told me this a while ago. Now I get to tell all you guys. IAUM BlackRock Gold ETF IAUM is the best way to get exposure to gold by far because it's the lowest expense ratio version, a 0.09% expense ratio. GLD has a 0.4, IAU has a 0.2. This is deep, and it's almost arguably always better to buy the ETF of gold over physical gold. Especially in smaller quantities, whenever you go buy small amounts of gold, you're paying the spot fee price when you buy it and when you sell it, and if you own a large quantity of it, you're paying to get it stored somewhere. So arguably the best way, lowest fee way, unless literally I guess a lot of people like to own gold in case just the world ends, but unless literally the internet crashes, because this is SIPC insured, it really does just follow whatever big gold does, even if BlackRock messes it up. IAUM, there you go. Let's see here. Yeah, that's the cheapest way to get XAU to USD. Okay. What app is it? Yeah, hey, if you want to get this app I'm on, it's in the link tree in my bio, that very first link there. Yeah, or if you're on YouTube, it's in the link in the description. It's actually a brokerage. Tingrika said, how's Generac? Yo, what's the ticker symbol? Or GenErac. GNRC. Okay, so this one is kind of like a... Okay, there we go. So yeah, Generac, they sell a bunch of those like generators and stuff. Whenever there's storm season or hurricane season, people always load up on this stock is really cyclical. Dang, they really monstered up rallying in 2021 when I guess everyone wanted to power their stuff at home. So now it's kind of just getting back to reality. The PE it's honestly, this stock is sadly fairly valued here. Like this is where it really should be for a company like this. The PE is a 27. Let's see their net income down here. So yeah, the net income really did fall 40% year over year. So that's a big miss. Look at that. The revenue fell, or the analysts expected 1.19. They missed only one. So they missed on revenue, a big miss on EPS, and a big miss on EBITDA. So triple missing on every metric like that, and the slow growth probably makes it maybe even overvalued. I mean, a 27 PE. How's the revenue? So the sales are negative. Revenue's down 5. Margins collapsed. Honestly, I'm not seeing too much blowing me away for Generac. If you wanted to buy a really weather beneficiary, more so than Generac, first off, I would pick a Home Depot or just a Carlisle Group. it's less cyclical because they're a roofing repair company, but they're still interest rate sensitive. But they've proven that though. Okay, I'm looking at health and consumers to diversify away from big tech and metal minerals. Hey, I think, is it XLV? Yeah, here it is. XLV. This is an interesting ETF. Look at that. I think, yeah, healthcare, the ETF was pretty much at an all-time high, pretty close to an all-time high. If you don't know which individual, healthcare name, part of this ETF has been so heavily, basically artificially suppressed because of UNH and all the Medicare, Medicaid providers doing so bad. But if you go to the top holdings, I love these. Eli Lilly, great, phenomenal, never sell. Johnson & Johnson, I'm really bullish on their oncology. Like, surprisingly, because their oncology business the past year, this has turned from like some boring blue chip, the most blue chip of blue chip stocks of all time, to an honestly interesting growth story on Johnson & Johnson on top of its dividend. Risk reward doesn't look great here, but AbbVie, dude, I love this ETF. AbbVie's a never sell. Okay. NU, please. Hey, what up, SM? Let's do NU stock. This is actually a crypto bank. I love this one. A few stocks to look at is BMI and MSI. Yo, Badger Meter's a really cool one. Oh, yeah. Hey, remind me to get to PayPal. What up, Hunter and Tesla? Hey, I'm sorry if I'm missing on all these stocks here. I'll try and get to all these. But here's NU Holdings. What up, Charlie? We'll get to that one too. So NU Holdings, this is actually a crypto bank out of Brazil. Is there an AI earnings sub? So let's see. Customer base reached 127 million, with Mexico surpassing 13 million users, Colombia reaching 4 million, Brazil maintained stable. Revenue growth of 47% was supported by a 42% increase in credit portfolio. Well, anyway, here's the best part about NU. Again, yeah, this is none of the revenue comes from America. 140K, 8.4 billion of the revenue comes from Brazil. 5.7% Mexico, but I love how growthy they are. This is why they're on my watch list, and I'm watching this one. The revenue's up 42, after grew 37, after grew 65, after grew 85. Like, you're on a streak of growth. Also, I believe Berkshire Hathaway, which is Warren Buffett's company, also owns a bit of this company. But look at the, that's the top line growth. So the revenue's growing nicely, but look at the bottom line. And again, this is in USD. 780 million of net income, up 41% after it grew 80. Like, they're printing net income, $2 billion plus in net income a year. So what's the PE ratio again? The PE ratio is, okay, so a 30 PE. So that's fair. That's super fair for that kind of growth. A 30 PE on NU is definitely deserving. I love this name. Their financials, again, they probably deserve somewhat of a lower multiple because they're in Mexico, Brazil, but that's where you want to be for crypto transactional, like, as a platform bank, because they're also applying for the US banking charter right now. But down there in Brazil and Mexico, where their currency sucks, that's where they actually would use crypto for transactional purposes. Here in the US, like, it's kind of, you don't really pay for stuff with crypto. You don't really need to. Our currency's fine. But in those markets, it's more. Okay, so let's look at Badger Meter right here. This is an interesting water meter play. Let me look at NUTX too. The forward PE is a 35. So they trade at 35 times next year's net income. Let's see. Actually, is there I doubt it. Okay. Innovator. So they're an innovator, manufacturer, and marketer of products incorporating flow measurement, quality control. Well, let's see down here. What they report. So this quarter, they beat on revenue, they beat on EPS, and they beat on EBITDA. Wow, by a good margin too. That was a real good triple beat quarter. So yeah, revenue's up 13, net income's up by 9. They have a dividend too. Yeah, you get a 1% yield. They raise their dividend every single year. Let's go see how much the dividend costs versus how much they make. So they made 35 mil. They made 35 mil in net income. After paying 9 million of taxes. So that's real. They made 35 mil in net income, and the dividend cost 11 million. So yeah, safe 33% payout ratio on the most recent quarter. So interesting name there. Can't really be hurt by AI. So NUTX. Okay. Someone said, oh yeah, we'll get to Tesla in a minute here. I don't have anything good to say about Tesla, sadly. So, quick heads up there. It's not bad news for Tesla. But if we go to Nutex Health right here, what is the market cap here? Yeah, this is a $900 million company. Really small market cap. We don't really cover these, but let's do it anyway. So hospital division. Okay, so they own a hospital group. Actually, look at that growth. This is actually why I'm not going to completely dismiss this name now. That's fascinating. That's triple digit growth. It like jumped up so much in one quarter. I bet they did an acquisition. And let's go check. Here's how you tell. Go to the cash from investing activities down here. And no, they didn't. They didn't buy. They didn't buy. They didn't artificially create that growth. That was like their real company doing that. That's actually so interesting. I'll look more into that. But yeah, they did 267 mil of revenue, and out of that, 96 million of that was net income, and that's after they paid 30 mil of taxes. Huh. Honestly, this looks great. Let's see. So, operation of healthcare facilities, it operates through. Well, let's check out their health right here. Or, I mean, their website. The future of healthcare. So they have 24 quality care facilities. So okay, cool. Actually, they could be like a smaller HCA Healthcare. What's the multiple? Yeah, actually, I really like. Honestly, these are great numbers. Yeah, 20. Okay. So they trade at 21 times next year's net income. So so the net income I think is supposed to go down a little bit, but 21 times next year's net income. That's certainly fair, though. That's certainly fair for this sort of growth. Wish I could give you more thoughts on them. Like it's like weirdly, it's like done weirdly bad, but honestly, it's done well. Well, it's not actually. It's done phenomenal since 3 quarters ago when they first announced that growth. Honestly, that's good numbers there. So AVAV. Novo Nordisk. Yo, Meta's a good buy too. What up, Carson? Yeah, Meta's the cheapest Mag 7 right now. But here's AeroVironment, $13 billion company. Extremely expensive though. They trade at 600 times next year's net income. But again, that's because they just now got profitable. Well, looks like they were consistently making profits, but then it went negative this quarter. Was that from an acquisition though? Oh, probably acquisition related. Look at the balance sheet. Look, the assets went from 1 billion to 5 billion. And they spent, you go to the cash from investing activities. Again, you want this to be negative. If this number is positive, that means they're actively selling out of their own assets to get cash. So you always want this to be negative. But the reason it spiked up is because they bought a company this quarter. And that also explains why the balance sheet rocketed up. And that also explains why the sales went up. And maybe also explains why they went maybe artificially net income negative. Anywho, looks like the growth is going to be there. Yeah, 500 mil of revenue up from 200 mil. Looks like they're in autonomous systems and in space, cyber, and directed energy. Huh. Interesting there. So, all right, Tesla, this company trades at 224 times next year's net income. Like it's right now, valuation is ridiculous. So we give them the benefit out. Look at the forward PE. It's still nutty. They're trading at 220 times next year's net income. This is nowhere near like a sane multiple, but it's Tesla and it has a mind of its own. And this is the stock that fundamentals don't matter. So it's almost looking at financials. I almost shouldn't, but basically, if you're wondering how's the multiple so high, again, 230 times next year's net income. The stock is $300 or $400 right now. Literally $150 of their stock price are from their 2029, 2028 estimates of their robotaxi and robotics network division, which I think there's just so much future hopium about Tesla that just like any other stock is like worth buying over this, I think. But again, me being so bearish, it doesn't matter. The stock will still probably do good and it's done great, but it's just not one that I want to risk my money with. I think there's so many better risk to rewards, like from a fundamental point of view elsewhere. Like the revenue was negative last quarter. Actually, the revenue grew 11% year over year, but the net income fell by 36%, and that was real. Gross margins fell 10%. Net margins fell by 43%. Their margins are getting crushed because their tax credits just got taken away from a long time ago. There was this Inflation Reduction Act, which gave them tax credits that just got removed. And there's some other, but anyway, wouldn't buy Tesla. What happens is, so hey, what up, Carson? Yeah, by the way, this is actually a software, a brokerage where you buy stocks on. If you want to get this app I'm on, it's in the link tree in my bio, very first link there. It is an affiliate link to full disclosure. So if you go and like deposit $100, we'll both get like some free stocks, which is pretty cool. So yeah. Yeah, it's just, or brokerage. You don't even have to use my affiliate link. You can just type it into Google if you want. It's just a broker called Moomoo, my favorite one. Or actually, all these brokerages are all in the link tree in my bio. I'm not sure which one you meant there, but yeah, you probably meant Moomoo because this is the one we've been using. This is my favorite one, most useful one. It's free, costs nothing, no commissions, no fees. My favorite one. Like with Robinhood, you got to pay $5 a month. So that's why, honestly, if I was just starting, even this is the all-in-one brokerage, most useful analysis. Okay, I'm actually about to end the stream here. We'll look at one or two more stocks here. Hey, shout out R Hunter. He says he bought some Amazon and Uber on the dip. Yo, those are two phenomenal names that those are never sell names. Your future self will thank you for that. I would dollar cost, or wait, AMZU. I think you meant AMZN. I'd be more careful with some of the like the 2x leverage ETFs. I'd honestly rather just Amazon's already moved so much. I'd rather just own Amazon. But um, I, Uber's great. So just a good dividend growth stock for the long term. Hey, what up, Push? I like honestly, I have a dividend only portfolio. If we head over here, if you go on the top left, it's called our dividend only portfolio. It's called dividend only, but most of these are, like you said, dividend growth stocks where they're not just suffocating themselves with a high dividend payout ratio. These are good dividend. Whether most of your total return is coming from stock price appreciation and not dividends, like Google, Meta, Constellation Energy, United Rentals. All these have well under 1% dividend yields, but they still pay a dividend. And in 5 to 10 years from now, like these are the kind of stocks you want to own right now. For in 5 to 10 years from now, your dividend income will be significant. Supermicro, they make servers for data centers. Yeah, hey, what up, everyday? Yo, Supermicro's been one of my biggest losers. Not one I'd buy or recommend, sadly. And I'm a shareholder. I got 10 shares in them. And if you were to own them and buy them, you, just like me, you would not want to have them nowhere near a meaningful size position. Like, I can't stress that enough, especially for Supermicro. You'd want to leave the meaningful size positions to the ones with real moats and not the server installers, but you'd leave that to like AMD. But here's Supermicro right here. The reason I don't like them anymore is because the growth is gone and the margins are gone. If we look at the revenue declined 15% year over year. So the sales are down 15 and the net income is down by 60. And that's not some one-time adjustment either. Like the net income really fell 60% year over year. So what that means is the net margins have collapsed. They have no margins anymore. There's so much increased competition from Dell. Like there's nothing exclusive to Supermicro that no one else can't do. So unfortunately, I wouldn't, they sell a commodity. I wouldn't have Supermicro as a big size position, but they're certainly cheap. I think the forward PE is like a 15, but the growth is gone. So that's kind of why they deserve that PE. Hey, Push says, thanks, love from India. Hey, awesome. Nice to meet you. Yo, if anyone wants to hit the follow button, we stream every day. I'm actually about to end the stream here, but I sell nothing. I have no course book, WhatsApp. I'll never follow you, DM you. Watch out for people impersonating me. What should I do if I have 6K and I want to invest it? Well, first off, I would not, if you have 6K ready to invest, I would not invest all 6K of it right instantly. I recommend dollar cost averaging, DCA. But first, you want to have the backbone of your portfolio in the S&P 500. I kid you not, and most people will ignore this, but you really need to follow this first step. Most retail investors, and not just retail investors, most hedge funds cannot keep up with the S&P 500's 8 to 10% CAGR. So you need to at least keep this as the backbone of your portfolio. If not, you need to just own a little bit of it. And then I would pick some of the S&P 500 names that you know, love, and use that have good financials. Like Meta owns Instagram, Facebook, Threads, use United Rentals, Constellation Energy. Our utility bills through them, but they're the number one nuclear play. 30% of all the nuclear reactors, like McDonald's, Google, if you like YouTube, Amazon, if you have an Amazon Prime subscription, or Amazon, if you like Twitch, buy Amazon, don't just buy a stock because you've heard of them. I mean, like I wouldn't buy Ford just because I've heard of Ford. Ford doesn't have great numbers, but I'd stay away from like the risky meme stocks with no revenue and no net income, the small micro caps. You can entertain those with very small positions, but keep the backbone of your portfolio in actual good stuff. So yeah, and this portfolio specifically, this is called our buy and never sell portfolio. These are all stocks that I think are like buy and never sells, great stocks. What's the end game? Yeah, hey, the end game. Hey, what up, Feed? Yo, the stocks aren't get rich quick. It's nothing like that. And if you have that intention, you won't get the returns that you want. It's literally just to slowly build and preserve wealth. It's to get that 10% CAGR. It's not get rich quick. It's to turn $100 into 110, then the 110 to 128, then 128 into 190. Like the snowball effect happens, and it's provably S&P 500. It's better to keep it in there than to just keep cash in your account losing interest. So yeah, why not put some money to work? Again, don't buy risky stuff. Always do your own research. None of this is financial advice. I'm not an expert. I don't sound nothing. But yeah, that's the stream. I'm going to end this with a quick portfolio update. Sorry if I didn't get to some of those stocks. I apologize. Oh, Zebra Tech. Hey, Zebra is like I see these at like Zebra Scanning Technologies. I actually live next to one of their huge facilities. It has like a huge zebra logo on the side. But yeah, they make I think the growth is gone. Well, let's see. They make like these scanning technologies. Yeah, look at the growth. It's 5% when last year was 31. So the revenue's 5, and the net income went negative. Net income fell 26%. And yikes, that was real too. Looks like the margins just collapsed or went negative. So asset intelligence tracking. So like some grocery stores as well. If you ever go to a grocery store, the little scanners at the bottom, like at Publix, like those are by Zebra. Very interesting. No, free me. I'm so sorry, dude. Yeah, I'm pretty much in the stream here. I hope you guys have a great rest of your day. Let me give you a quick portfolio update. This is known as our Moomoo account, where of course once you buy a stock in here, I try not to ever sell it. And these are all the stocks that I own in here. Certainly looking to buy more Amphenol next week. It's not a great valuation. Actually, Amazon too. I'm going to deposit $500 next week in this account. But I'll be looking at my one more. Actually, next week is really boring because there's only 2 full trading days next week, I think. But usually that week, almost always statistically, is super green because there's just no sellers. That's why we always get the statistical Santa Claus rally because there's just no sellers on the order book. No one's trading. But anyway, yeah, here's our Webull account. Don't listen to me. I'm not an expert. We're only up 8% all time in here. We just like literally 2 weeks ago, we were up like 20 to 30%. So it was like this past week, 2 weeks that have crushed us because we have such a high volatility portfolio. Like, look at this. We got Robinhood, AMD, SoFi, Reddit, Super Micro, that tanked. So, and we got some really bad losers as well, but I deemed a lot of these like too cheap to sell. Like Zoom reports next week, UiPath, Sprouts Farmers, these are way too cheap to sell. I'm actually looking at, actually one of the stocks at the top of my watch list right now to buy the dip on is Sprouts Farmers. It's one of my top stocks, I think. Again, not a huge size position, kind of boring grocery store, but I think the valuation looks very fair. 15 PE. You won't believe the share buybacks on Sprouts Farmers too. I'm going to make a video soon about like a compilation of stocks. Like I'm going to go over Uber, Sprouts Farmers Market, like stocks that are, and Dell. And you wouldn't have Dell as a huge position either, but they do crazy buybacks. Anyway, and then we have our Robinhood portfolio, which is our dividend-only account. Every stock in here pays a dividend. Meta, Google. We just looked at that. We also have a Roth IRA, which has done not good at all. Started it basically a year ago, and we're down, 1%. Yeah, these are all the stocks that we got in here. We've kind of consolidated it. Our largest holding in here is now HCA Healthcare, my favorite like healthcare name of all time. Now I'm talking like I've never seen a company with more impressive financials. Also, Iron Mountain. We bought some more of them. Core Medics. Webull last week, we bought all those stocks. So yeah. Why Amphenol? Because I'm super bullish on Amphenol. So Amphenol, on top of just their already business being bullish, Amphenol acquired, if we go to CommScope right here, the reason the stock gapped up as much is because Amphenol is acquiring their largest business right here, their CCS business, cable connectivity and cable business. And this, not even their team expected this. And this is why it's so good for Amphenol. This is now going to Amphenol, 51% growth year over year. And it was like surpassing by far. Amphenol was so smart to buy it like before that quarter. Like, I don't even get it. But wait, what was that? CCS, it was boosted from data center demand. Anywho, I got to go. Hope you guys have a great rest of your day. We stream every day if you want to hit the follow button. Oh, yeah. And if you're still on the YouTube stream, hit the like button or hit the follow button. Thank you. I've been streaming for basically 3 hours now. My head hurts and I'm starting to lose words. Hey, see you, Brian. See you, Free Me. Ralph. Thanks, Nick. Push. Thank you all for being here on the YouTube stream. Thanks for being on the YouTube stream because, as you know, I'm trying to build on my YouTube channel more than my TikTok. My TikTok gets like way more viewers. But thank you all for being on the YouTube.